Great. Good afternoon, friends. This is C.A. Samir Chaudhary, and today
Recording in progress.
we are going to discuss with a topic of user addition in income tax laws and implementation issues on Schedule 3 amendments. Friends, we all knows कि कोविड ने बहुत लोगों से बहुत कुछ छीन लिया, but one thing is good that the technology bring us together. आज इंडिया के अलग अलग पार्ट में सभी दोस्त साथ में आके एक सेशन ले रहे हैं, and special thanks to श्री प्रकाश शर्मा sir, who is the chairman of CMP committee, and CA Purushottam Khandelwal sir, who is a vice chair of CMP, to organize such a nice event and to add on knowledge on this Saturday afternoon. And friends, we have with us our eminent speaker, C.A. Divyang Shah, my friend. And friends, let's start without wasting much more time. I request Purushottam sir to say a few words on the session to lightening the session. Thank you, sir.
Good afternoon, respected chairman of the committee for member in practice in absentia C. Prakash Sharma ji, young dynamic treasurer of Ahmedabad branch Samir Chaudhary, eminent faculty and my dear friend Divyang Shah, secretary of this committee Rajnikanth Verma, Malhotra ji, who are instrumental in organizing this a wonderful seminar for the members. As you know, on the 21st day of June, we got an opportunity to interact and do yoga with the Baba Ramdev. The intention of institutes to keep our member physically fit, mentally fit, and thereafter, committee for member in practice is dedicated to equip our member to produce the best result. Currently, I am serving as a vice chairman of committee for member in practice. We have taken various initiatives to equip our members to carry out a attestation function with honesty, dedication, and full of knowledge. Our committee is organizing various seminar, conference, national programs, meetings, mentoring programs for the members. We have developed a tool for the members to equip them. One of them is the audit analytical software, and another is a practice management software. These both software will help to the member. Number one is the audit analytical software, how to analysis the audit before you reaching to the final conclusion on audit report. We have given you the software to analysis the data for which you have carried out the audit. And another, the SMP practice or a medium-sized practice, highly reliant on the physical management of the office, but we are developing a software which help our members to manage the practice in a better way. So these two software we will make available to member in very short times. Our committee meeting will be held on 27th of this meeting at Delhi, and after considering my council colleague and their views, we will make available the software to the members. Again, my committee is holding a post-certificate course for the members. One course is the certificate course on wealth management and financial planning. Another is the certificate course on working paper management. And third one is very important, certificate course on preparation of appeal, drafting of deed and document, and representation before appellate authority and statutory body. So these are the initiatives we have taken in my committee. Out of that, our committee is ready to help the member. We have tied up with the various insurance company to get a huge discounts. So I request member to, once you visit the CMP benefits site of the ICI, and take the maximum benefit for which we are trying our best. And today's topic is the judicial edition in the income tax law, and another topic it will be taken by Dr. CA Anand Banka, implication issues on the Schedule 3 amendment. So what precautions you have to take before filing the income tax returns so you can avoid the usual addition. And my dear and eminent faculty, Divyank Shah is here to discuss with you. I will not take much of your time. I hand over the charge to Samir Bhai Chaudhary to take it as further. Thank you, Samir Bhai, for giving me an opportunity to interact with the members. Thank you so much.
Thank you, sir, for kind words and to enlighten on the various activities the committee is taking care of. Friends, Prakash Sharma will join us within few moments. So without now wasting anyone's time, we are starting with the session and we are introducing our eminent speaker of today, Divyank Shah. Friends, practicing chartered account, he's a practicing CA having a main practice of appeal since 2010 and has served our institute, especially Ahmedabad branch, since 2012 till date. He also remained a member of Direct Tax Committee for giving a post-budget memorandum on finance and various years and a regular speaker at Ahmedabad branch. He remained a faculty at the certificate course by the ICI for the members, has also delivered lectures to income tax officers and its inspector on different forums. Also visiting faculty at Bank of Baroda, HN Institute of Commerce, Ahmedabad University, BK Majumdar Institute of Business Administration, Ahmedabad University, also delivered many lectures at different study circles and also at different branches of WRC of ICI for the larger benefit of the CA fraternity. He is a faculty at CA Association, MSOP training at Ahmedabad chapter of Institute of Company Secretary and at various forums. So Divyank bhai, if I'm not wrong, you have already delivered more than 1,000 lectures to various platforms and
Yes.
to deliver the things that what are the usual additions in income tax laws for which even the client and even we all the professionals are in dilemma कि आज कौन सा एडिशन होने वाला है. So sir, you are the best person to guide us on the same. The floor is yours now. Sir, take charge of it. Thank you, sir.
Thank you. Samir Bhai Chaudhary, my dear friend and the elected member of the Ahmedabad branch, chairman of the committee for member for in practice, CA Prakash Sharma, and obviously a dynamic central council member and my mentor and guide also, CA Purushottam Ji Khandelwal, who is very, very, very dynamic as far as I know. And also really good that you are so much actions are taken where it was a committed and so much is done where things are required to be done. So with this brief thing, would like to directly move on the topic. Now, topic for the day is the usual additions. What is taking place while having the scrutiny assessment in the income tax law? Now, first of all, this topic would be really important as per my consideration because of the one or two reasons. First reason that now the assessment proceeding, not only assessment proceeding, but also first appellate level, that is a faceless, that a first appellate level is a CIT appeal has gone a faceless. So now everything will be online. So gone are the days when we are sitting in front of the assessing officer and we were trying to explain our stand that addition should not be made. That's the how 90 or maybe 99% CA are comfortable to explain their side. Obviously, that was very comfortable thing, but now that is stopped. So anything you would like to explain to the assessing officer or CIT appeal, you need to draft it and draft it in a way that your point is explained and also he can refer whatever he wish to refer easily. How it will be, I'll discuss later on. So because of this reason, I think though lots of people are saying scrutinies are reduced comparatively, but still additions are increased if I'm not wrong. So because of that reason, I think we need to know more about the sites because that's what happened most of the time. Just a minute. See what happens most of the time, what happens that if addition took place, we always try to explain the addition on the merits of the case. For example, some expenditure is there on which TDS is not deducted. So we always try to prove the TDS is not applicable. But if we don't want to get that disallowance, then there is also another side which says if a TDS on any expenditure is not deducted and recipient on said income, for us it is expenditure, for the recipient side it is the income. So if a recipient has already offered that as an income, has paid the tax on that return income, and for that CA certificate is given, then in that case no disallowance should be made. This provision is already there since last many years, but still lots of very less people are trying to take the benefit. This is the thing now. one more thing, Lord. What happens? Sometimes on the merits of the case, we cannot get the addition deleted. So lots of technicalities are there which we need to comply, and also the assessing officer need to comply. If assessing officer did not comply, then that addition cannot be there. For this reason, before I may start still my session, I would like to give the simple example that lots of notices under section 148 were issued after 1st of April 2021. Now, as after 1st April 2021, there is an amendment in the income tax law. Income tax officer need to comply the section 148A, but they did not comply. So lots of writ has filed, and then after matter reached to Supreme Court, wherein Supreme Court said that whatever notices under section 148 were issued, those notice will be considered as a notice under section 148A. So now, because of this amendment, what is the conclusion, which I explain in detail later on, but conclusion will be that if any notice is before of 3 years from the end of the relevant assessment year, and that concern addition is only below the 50 lakh, then notice itself cannot be issued. This is because of the Supreme Court judgment. If this is not known to you, you will always fight or submit your details on merits of the case, and things will be there will be addition. So with this brief thing, let's jump on to the directly some of the topic. My first topic I'm just sharing a very small PPT available over here. Just a minute. So done. So my first topic, first of all, there are lots of addition which for which different solutions are there. I'm taking a very recent one. As of now, let me take the background first of all. Income computation disclosure standard. So first of all, whenever we are calculating the total income under the income tax law, for that, first of all, we need to write the books of account. Now, for writing the books of account, whether any particular accounting standard we need to follow for under income tax law, answer is no. Different AS were issued by the ICI, but under income tax law, they have never mentioned that which accounting standard one has to need to follow. Though some power was there before, they have mentioned under the old power some two different accounting standards which were not much useful. So, how to calculate the income under the income tax law? They have issued the income computation disclosure standard, which is applicable effectively for assessment year 2018-19. Now, simultaneously, they have also issued some inserted section 43 CB, which says if you are calculating income under the head PGBP, that is the profits or gains from business or profession, and you are a contractor for a real estate or maybe service contract, then percentage of completion method you need to follow. This is the background. Now, under the ICDS, which particular ICDS is for the service contractor or the contractor, that is the ICDS 3, that is a contracting, ICDS for the contractor. Under that ICDS, it is mentioned. Now, what is scenario? For example, Mr. X is a builder wherein Divyang got a contract for designing the building. So I just need to design the building. My work will be spanning for 5 to 6 months, for which my payment will be, for example, 10 lakh. This is, so I'm a service contractor. Yes, I'm a service contractor. Let me say, for example, there is a builder, Mr. X, and Divyang receives the contract for having the interior. First thing, let's say, or there is a contract for the building the whole structure of the RCC, not the other part of the building. So I'm the contractor. Yes, for this constructing the building, developer has decided to pay me, for example, 1 crore. Now this construction will go for 2 years, for example. So I'll get my payment in a piecemeal manner. For this kind of cases, there is ICDS 3, which talks about the contractor, and in that case, that ICDS 3 will be applicable to me. And in that case, I need to declare my income based on the percentage of completion method, meaning thereby after 1 year, for example, 50% work is completed, the certificate is available. So, for example, my total revenue decided is 1 crore. Of that 1 crore, I need to declare the 50% as my income for income tax law. This is what ICDS 3 talks about, because those ICDS is for contractor. Now, what is happening in the assessment proceedings? Lots of assessing officer has a misconception that this ICDS 3, which talks about the percentage of completion method, is applicable to the real estate developer also. Now, before we may jump to this point, there's a developer. Let us understand what are the developer, who are the contractor. For example, there is a Bakeri group in the Gujarat. If that Bakeri group has decided to build a building, so those Bakeri group basically is a developer. But Bakeri group himself of themselves will not execute the complete contract for the sewage system, or maybe for the different line works or electrification work, for construction work, for designing work, for the interior work. Different kind of works are there. Those work will be given to different contractor, and to contractor they will pay the amount when the work will be completed, and some amount will be also paid on the partial completion of the sum of the work. So in this case, Bakeri group is a basically developer who actually developed the property, and the remaining contractors are the basically real contractors who will be fall under the ICDS 3. So now, during the assessment proceeding, what is happening in the hands of the developer who actually develop the real estate property? Real estate property means developing a not only building that is a commercial or residential complex, but also the plotting scheme will be covered in the real estate development. So in the developer also, they consider that as ICDS is notified and section 43CB says that percentage completion method is compulsory, even developer has to follow the percentage of completion method. And because of this reason, they simply make the addition, because developer normally do not follow the percentage of completion method. Why so? Because for example, I am the developer. For example, there is a scheme. In the scheme, there are approximately 100 residential houses are there. When scheme started of the construction started, for example, it will take 3 years. So up to 3 years, I'll take the advance or can take the advance for the property. And when the property will be completed, I'll transfer the said property to the respective buyer. But there will be also some property which will not be sold till the property, this real estate project will be completed. So for example, out of 100, only 20 properties are there for which I receive the advance in the first 3 years, wherein the project is under construction. So for first 3 years, can I record any revenue? Answer is no, because there is no contract. Am I going to, as a contract, am I as a builder, am I going to get a particular percentage of a contract price? No. Different buyers are there. They may buy my property individually or may not buy. After completion of the project, there could be a lot of stocks, that is a constructed residential house, which may not have sold at all. So at that time, if I follow the percentage of completion method, I'll offer the income, will pay the tax, though there is no actual revenue. So that was never the intention. So first of all, if this kind of additions are taking place, what as a chartered accountant or authorized representative of the assessee you should do? First of all, let's do one thing, refer to section 43CB. I'm just sharing the slide individually. Now, I think we can refer this section 43CB. This is the section based on which they are actually compelling the developer to follow the percentage of completion method. I'm referring that section, subsection 1, the profits and gains arising from a construction contract or a contract for providing services shall determine on the basis of the percentage of completion method in accordance with the income computation and disclosure standard notified under subsection 2 of section 145. If you refer the ICDS, then different ICDS are there, wherein ICDS number 3 is there, which talks about this method of percentage of completion method for a construction contract or a contract for providing services. Now, this section itself is inserted by the Finance Act 2018 from assessment year 2017-18. So because of this reason, assessing officers are saying the developer need to follow this. First of all, this is the reason. Now, if you refer the ICDS 3, and this is the construction contract. In that case, if you refer the calculation how it should be made, they said that retention money is there. Retention money means, for example, the person who award the contract takes some amount as a retention, that this amount shall be retained by the award giver of the contract. And I am executing the contract, I'll not get the 10% of the contract amount. So based on this kind of the calculation, contract price is decided. Over here in developer, there is no kind such price is decided. First thing. Second thing, when ICDs earlier were issued, the different draft ICDs were issued. So at that time in 2017, the CBDT has also issued, just a minute. The CBDT has also issued the draft ICDs for the real estate developer separately. So that is very much clear that in that case, obviously, these ICDs 3 is not applicable to builder or the developer. And most IMP, after ICDs are implemented, they have issued the different question answer FAQ, wherein at question number 12, CBDT themselves has cleared that ICDS 3 will not be applicable to developer, rather general ICDS, that is a revenue recognition. ICDS will be applicable to the developer. So I'd like to refer that part also. And one more request to all the viewers over here or the participants, if you had any query, you can post the same in the chat box. I don't know in the virtual mode how we'll post the same in the chat box, but that will be easier option. And we are going to take the question answer at the end of the session for sure. Still, I would request whatever queries are there, you can post the same directly as of now. Now, we are referring the ICDS question, FAQ for the ICDS. Just a minute. So what we are watching on the screen is the clarification on income computation disclosure standard issued by the CBDT as on by circular number 10 2017 as on 23rd of March 2017. Now we are now moving to question number 12. This can help you to solve a lot of query. Question number 12 talks about, since there is a no specific scope exclusion for real estate developer and build operate transfer projects. If the same is not visible, let me, I don't know. Just I'm reading that since there is a no specific scope of exclusion for real estate developer and build operate transfer projects from ICDS 4 on revenue recognition, please clarify whether ICDS 3 and 4 should be applied by the real estate developer and BOT operator. Also, whether ICDS is applicable for lease. To that question is very much clear at present. There is no specific ICDS notified for real estate developer, meaning thereby ICDS 3 is not a applicable specific ICDS for the developer. It is only for a construction contractor or a service contractor. Now, BOT projects lease, therefore relevant provisions of the Act and the ICDS shall apply to this transaction as may be applicable. So which other ICDS is applicable? That is a revenue recognition. That a general ICDS is there for recognizing the revenue. The general ICDS will be applicable for the developer. So if you got any addition because of this reason, this circular will obviously help you. And if you search on the Google, the draft ICDS for real estate developer will be available. So that can also be mentioned that for the real estate developer, draft ICDS was issued separately. So it is very much clear that this ICDS 3 will not be applicable to developer. And one more catch is there, when a draft ICDS for real estate developer is issued, that draft ICDS is then after never notified. So that draft ICDS is still not applicable. Okay, so it is not applicable for any assessment year. It is assessment 1819, 1920 or any subsequent assessment year. Any queries there for this part, you can post the same in the chat box or wherever it is possible for you, for the online participants. Give me a 2 minute more. So then after, so first of all, for the developer or the real estate developer, this ICDS 3 is not applicable. That's what we have discussed. Now, this point is also discussed over here. Now, another point I would like to discuss in the income tax law. We need to understand, before I discuss the topic, we need to understand some of the terms. First term is the res judicata. Now, what is the res judicata? For example, in the past assessment year, for example, our assessee is in a scrutiny for assessment year 18-19. In a past assessment year, the method which our assessee, who is a developer, followed is a project completion method. So he will record the revenue only when project is completed and units are actually sold. So in the past assessment year, that is the method adopted. Now, in this assessment year 18-19, without what we have discussed earlier, let's forget the same. Otherwise also, can he change the method? So answer to that, if the earlier assessment year, assessee has already followed the project completion method, not the percentage of completion method, then in this assessment year, the same cannot be changed without there being any reason. So we can always say in the past assessment year also, the same method is accepted. Just a second. The same method is already accepted. So in this year, without there being any reason, the method is not required to be changed. Now, I have used the term res judicata. In that context, I would like to mention some of the people have understanding that in the earlier assessment year, this contention is decided and that contention will be binding in a subsequent assessment year also. That is called res judicata. Now, res judicata could be applicable in the criminal or the civil proceeding. For income tax law, it cannot be applicable. Meaning thereby, for example, I take a stand that this property, for example, had a dispute wherein I am having my office. That property had a dispute, reached to court, and court decided that other party has no interest in this, and that's why this property is of a Divyangsha. Now, by any other party, whether the same party can say that this property is mine in subsequent assessment year, answer is no, because that issue is already decided. Okay, but the same logic will not apply to income tax, because for example, in earlier assessment year, while deciding which method is required to be followed, so issue is decided by AO in favor of the assessee, but law says that this other method should be followed. Section says something different. So just because in the past assessment year, assessing officer did something which was not right as per the law, then that conclusion of the AO in the earlier year will not be binding in this year as well, because there is a separate provision which was overlooked by the AO in the earlier assessment year. Am I clear? So res judicata is not applicable strictly, but we can always say there is a principle of the consistency. If in the earlier year assessing officer has accepted the project completion method, then in this year can he change the method without showing that there is any requirement under law? Answer is no. That is also called the principle of the consistency. So res judicata is not applicable to income tax proceeding, but principle of the consistency do applicable in the income tax proceedings. So based on this as well, we can say that method of accounting should not be changed. Am I clear? Moving to next. Now, second thing, what happens, for example, in assessment 18-19, assessing officer says that follow the percentage of completion method. Now, this scrutiny assessment, let's say, is going to be completed in the reassessment. The reassessment is going to be completed now on 31st of March 2023. Now, by the 2023, the project is already completed and whatever units are sold, they are already offered as income. So, if assessing officers contention is accepted that percentage of completion method should be adopted, first of all, then what about those incomes which are already offered in subsequent assessment year and which is already accepted by department because there is no scrutiny, an intimation is issued, or scrutiny took place and there is no addition is taken, rather income is accepted? In that case, we can always say if the assessing officer's contention is accepted, and for the same income, it will be taxed at 2 different assessment year. And double taxation is not allowed under the income tax law. So on this basis also, you can always say that if a method will be changed, there is no logic, because finally it is a tax neutral decision, because otherwise also whatever units are sold, all the units are sold and those are already offered as income. So if one assessing officer make the addition based on percentage completion method this year, then those income which is already offered in subsequent assessment year should be reduced. Now, that is not possible effectively. So based on this also, you can request to AO during the assessment proceeding or in the appellate mode that these changes should not be allowed. Am I clear? Now, so these are the points about this. Any question is there for this point? I think query can be raised. Moving to next point, till any query is not received by me, I would request that we can also take the query in between if the same can be mentioned in the chat box over this platform of the Zoom. Otherwise, yes, I'm skipping the same. Moving to next. Now, see what happens. Addition based on the Form 26 AS and the AIS. AIS stands for the Annual Information Statement. So, not this is the second year effectively for AIS, but since last 2 years, so we have available the Annual Information Statement. So, whatever financial transactions are there, which are done by the assessee, those transactions are available in form of TDS in 26 ES as well, but other transaction on which TDS was not deducted, those will also be now reflected in AIS. For example, for reporting in AIS, they also made a different amendment so that different informations are available. So if your client is registered under the GST regime, so whatever turnover or income you have offered under the form 3B, GSTR 3B, GSTR 1, all that information will be available in the AIS. Now, they've also made a specific amendment that whenever any interest, dividend is paid or capital gain in relation to shares or mutual funds are there, those transactions will be reported separately by the person who are actually dealing with the transaction. For example, interest is paid by the company, so that will be reported by company as in form of the AIS. Dividend same way. So those transactions will be available. As far as the real estate property, if you have purchased more than 30 lakh or sold, value of which is more than 30 lakh, that will be available in AIS. For example, if you have purchased the mutual fund more than 10 lakh in a year, having the fixed deposit invested in a fixed deposit more than 10 lakh, have deposited cash more than 10 lakh in the bank account, that all transactions will be reflected in EIS. So now, lot of transactions are there. So why I'm taking this point now onwards, from assessment year 20 to 23 second year and 21-22 AIS is available. So whenever scrutiny will be initiated for this assessment year, assessing officer will check EIS also, whether a transaction is there. For example, in EIS, it is shown that you have received the, for example, dividend of rupees, for example, interest of rupees 5 lakh, and you have not offered the interest at all. So he will make the addition. This kind of addition were already taking place based on the Form 26 AS. So how to deal with this kind of addition if made by assessing officer? So that is a bifurcated over here. First of all, let's take a scenario that in Form 26 AS or AIS, there is income is there. I have no one case wherein in my client case, there was a payment of a 194C. Amount was 1 crore. But assessee has not received any amount at all. Someone has reported, maybe wrongly or maybe intentionally is reported. Well, I don't know whatever the reason is are, but that amount is reflected in my 26 years that I have received the 1 crore on which TDS is deducted by deductor of rupees 1 lakh. So I have offered that income. Answer is no. So what assessing officer will do? He will simply say, have you offered it? No. So he will make the addition of rupees 1 crore and he will also grant the TDS credit of rupees 1 lakh. Now, in this kind of cases, first of all, whenever you have filed the return, you are not required to take the credit of rupees 1 lakh. if at the time of filing the return, if you have already taken the credit of rupees 1 lakh, then it is a deemed, you have deemed accepted that income of 1 crore belongs to me. So you should not do that. So if in your client case, whenever you are filing the return and verify there is no income which is not belong to the assessee, and in that case don't claim the credit of that corresponding TDS amount shown on the form 26ES or AIS. Done? Now, first thing, if let me say, if this happens on in the assessment proceeding for your client, what should be your first action? For example, in my 26 years, there is a 1 crore of a receipt is shown, when TDS is 1 lakh. If I have not received that income, first of all, I need to provide my all the bank statement, and I need to ask to the AO with the contention that I have not received any single amount from this person till the date in this year itself. So if kindly verify the bank statement whether I have received the amount or not, because as per my books of account and bank statement, I have not received it. Now also put a request to assessing officer that this amount does not belong to me. Because of that reason, I does not have any contact with this party. So request to AO to issue the notice under section 133(6) to the deductor and ask for the confirmation of this transaction. You need to request to AO. Then after AO will issue the notice. And in any case, for example, AO issued the notice and the deductor did not give any reply, or assessing officer did not issue the notice at all, you can always say that this is the amount of 1 crore, out of which 1 lakh is TDS. So 99 lakh is the amount which is not received by me. So this amount, if considered as a my income, then that will become the receivable from the deductor, which I have not received. So if you wanted to make the addition, then my third argument will be, then try to collect this amount from the deductor itself, because I have not received it. Now, can the AO collect the amount from the deductor? Yes, section 222 subsection 3 clearly says the recovery proceedings that assessing officer has the power to recover the amount. For example, there is outstanding amount in my case, and there is a company who shows that company need to pay amount of rupees 10 lakh to Divyang. So can they issue the notice to that company that whatever amount is payable to Divyang, pay to the income tax department, because we are supposed to have the outstanding in the name of Divyang? Yes, they can do so, and they have done so earlier also by the department. So you can post this thing. So this is the thing. And despite of this efforts also, if the addition took place, then there are plethora of judgments are available which says that just because deductor has filed some TDS return which shows the some wrong information, and that income is not received by the payee, that is a Divyang, that income cannot be subject matter of addition in the hands of the Divyang. Am I clear? So this is the another thing which could be useful for in a scrutiny assessment as well as in the appellate stage. For appellate stage, I would like to refer the one tribunal judgment of the Surat. Just a minute. Now, this is very recent judgment of the Surat Tribunal, wherein Honorable Tribunal has clearly held like this, where a payment was reflected in Form 26AS and was shown to have been made to assessee. It could not be brought to tax if it could not be established that assessee was actually beneficiary of said payment. This is the conclusion. Now, before pronouncing this order, Honorable Tribunal Surat Bench has already relied on the judgment of the Mumbai Tribunal over here. Mumbai Tribunal and also Ahmedabad Tribunal and also a Jabalpur Tribunal. They have relied on the judgment of this. So this is a quite settled position, but you need to be careful that you have not received the payment and you have provided all the bank statement. So assessing officer can verify. You can also provide your books of account confirmation. If a account is not available of that party, you can simply give an affidavit or a declaration that that party does not have any transaction. So based on this judgment, the addition based on Form 26 ES as well as AIS cannot be made. Believe me, lots of reporting error will be made by lots of deductor, wherein because of that reporting error, which they will never rectify very soon, because of that, deductee's hand will be full with the demand because addition will be made in the hands of the deductee. So this judgment will be helpful a lot. If you are interested, you can note it down. Moving to next part. Any queries there for this part? I would love to give the answer earlier as well. Then moving to next. So now, next point, see what happens. Sometimes in most of the cases, in my 26 years, amount shown from a party Mr. X is 11 lakh 80,000. But in my books of account, I have shown the income of rupees 10 lakh. So Form 26 AS entry is not fully incorrect, but it is not fully correct. So it is a partially correct or partially incorrect. So in that case, we need to prepare the reconciliation. In my example, reason for that difference is a GST. Because that party has a reported transaction along with the GST. That's why amount is 11 lakh 80,000 along with the GST. But I have maintained my books of account in an exclusive method, wherein a tax is a separately recorded, and my trading account will show only the 10 lakh rupees of the entry. So in this case, I need to provide the reconciliation. If you provide the reconciliation, I'm sure addition will not be there. And one more important thing I always try to repeat. I'm sure lots of how to handle the assessment proceeding. So lots of people, most of the people are habituated to explain his case by sitting in front of the assessing officer and explaining orally. But now, till show cause notice is issued, you will not get any chance to explain in person. Meaning thereby, if a once show cause notice is issued, then after you can file the reply, and then after assessing officer may grant you the opportunity of being heard through the video conference. So before that, you will not get the chance. And after getting the chance of video conference, it is difficult to explain on the video conference because lots of time there is a error or communication gap is there, and party or assessing officer is not able to hear us properly. And more thing, we cannot refer the documents easily because we are on page number so and so, but a assessing officer is not able to find that page number. So it is quite difficult to explain that. So because of this reason, I would like to suggest a simple thing. Very simple is there. Whenever anything, any submission you are putting in the assessment proceeding, try to put everything on the paper. So for example, my first contention is that disallowance under section 40A IA is not applicable because amount which is paid without TDS is below the limit, or form 15G is received or H is received, then clearly mention the submission. For example, there is another contention that in any case, if amount is TDS is applicable and your honor doesn't agree with our first contention, then give the separate opportunity so that we can prove that recipient has offered that income in his income tax return and he has paid tax on that, and because of that reason, if you disallow this expenditure, it is not required, because if your income is offered by recipient and on that tax is paid, the disallowance is not required. So put it in writing. So whatever contentions are there in the assessment proceedings, put in writing. One more thing, whatever you are writing in the submission, please try to prepare the point-wise summary. That will be extremely easier for assessing officer to read the relevant part only where he has a confusion. If you will, for example, whatever contentions are there, put the heading. That will be easiest one. And believe me, a very number of cases are there wherein addition is made, not because addition is required to be made, just because addition why should not be made is not understood by the assessing officer, though you explain properly. So please try to write everything on the submission. Try to put the everything on the point wise. Don't write don't prepare a submission like a essay. And third important thing, whenever you are mentioning that this is the thing, write down also along with the evidence on which basis you are saying that this is the amount of expenditure. So put a ledger copy, and ledger copy is attached here with the annexure number so and so. And also prepare the indexation. For example, I said somewhere in the submission that I am attaching the this evidence interest ledger of which annexure number is, for example, G. Now, on which page number G is available? If you have prepared the indexation, then assessing officer can refer easily indexation and he can refer that page number. Am I clear? So please give the indexation of your submission along with the attachment. And whenever you are putting or submitting your submission, then obviously you need to put the page number on each page because you are preparing indexation. So putting a page number is extremely easy. If you convert the Word file into PDF, in the PDF they are giving you option of putting a page number on the bottom of the page. It's quite easy. What you need to do, once prepare submission, have the numbering, and then after prepare the indexation. Then on which page number annexure G is available, A, B, C, D, E, F, G is available. Put the same in the indexation page. If you do this thing, believe me, as per my consideration, 30% chances are there that your case will be properly understood and no addition will be made. Am I clear with this part? The faceless assessment and appeal, this is extremely important part. So please try to follow this kind of method. And once, if you have prepared the standard format for having the indexation and page numbering of the submission, it can be done by your staff also who are not a qualified or only BCom or 12th pass. So no much intelligence or time is required to be given in this to implement this simple thing. Now moving to the topic. So in second kind of cases wherein form 26AS is there, wherein income is there, which is already offered by me, but amount is not matching. So try to reconcile the difference. If reconciliation is not possible at all, for example, I have done some government contract. As per my books of account, my income in a different 3 years totaling to rupees, for example, is a 30 lakh. Now I have offered 10 lakh in the first year, second 10 lakh in the second year, third 10 lakh in the third year. But somehow the government agency of whose work I have done has reported the transaction only in 1 year. That is third year. The 30 lakh ka kaam hua hai. Now if you refer the 1 year, it will obviously shown कि 20 लाख का आपने income कम दिखाया है. But if you show the complete all the years, then income shall be matched. So this can also be the one of the way to reconcile the form 26AS. If by this method also, after this method also, it is a conclusion that form 26AS की income गलत ही है, so what you can do one thing. First of all, खुद की लेजर कंफर्मेशन की दे दो कि भाई मेरा बुक्स ऑफ अकाउंट के हिसाब से ये इनकम है एंड उसने मुझे ये इस दिन पेमेंट किया है वो लेजर में दिखेगा यस and then after also provide your bank statement so assessing officer wish to verify bank statement he can verify. तो मैंने अपना लेजर दे दिया जिसमें मैंने अपनी इनकम दिखाई है, इनकम कब मिली है वो दिखाया है, अपना बैंक स्टेटमेंट दे दिया जिसमें कब कब इनकम मिली है उस पार्टी से वो दिख रहा है. नाउ ऑल्सो हेलो any issues there?
Just please carry on, sir. Please.
Okay, done.
Yeah.
Okay, done. So what happens in this case? So if this is not possible, all the methods what I discuss is not possible, you need to simply say कि भी मैंने अपना लेजर दे दिया, उसमें कब पेमेंट मिला है वो दिखा रहा हूँ, अपने बैंक स्टेटमेंट में आप पेमेंट देख लीजिए, इससे ज्यादा मुझे पेमेंट मिला नहीं है. So whatever additional income is shown by the deductor, it is a deductor's problem. He has a problem. He has makes a mistake in reporting. Because of this reason and based on the judgment which I shown you, that is Surat Tribunal, you can very well make sure that addition is not made. And if addition is made in the assessment, it can be removed easily in the appellate forum if you have filed these evidences. And also mention to assessing officer clearly, if you have a doubt that we have not offered income properly, you can get a confirmation from the third party, from deductor, and verify that our payment is matching or not. If genuinely our client has recorded less income, then there should not be any problem to pay the tax on the same, because finally they are going to get a income from the third party which they have not offered properly. So this is the thing you can follow. Again, I'm repeating, second scenario what we have discussed is the 26 ES income is not shown, 26 ES income is not fully correct, so you can follow this method. Point is written on the screen, you can refer the same. Again, I'm requesting all the participants, if you had any query, please post the same in the respective chat box so that we can refer it later on. Okay, otherwise you will forget the query. I'm really interested to solve all the queries. Shall we move to next? Second point is also discussed. Income is not offered fully in this year, but offered in the subsequent year. होता है ना, for example, this will happen mostly to professionals. Why professionals? For example, I'm following the cash basis, which is allowed for professionals, even to lawyers, doctors. So, for example, I raised the bill in March of a 10 lakh rupees, but I received that payment in the April 2021. So my income will be offered in a subsequent assessment year. So in that case, I also need to claim the TDS credit in a subsequent assessment year. But problem will be in the earlier year, my 26 years will show कि ये income है जो आपने offer नहीं की है. So in that case, you can show simply if the same income is very well offered in the subsequent assessment year, and as the same income is already offered, obviously which will not be disowned by the department, because what is scenario? You file the return, they will process the return in, under section 143(1), so they will deem accept it. They will accept it by default. So you can always claim that income is already accepted by department, though only intimation under section 143(1) is issued. So when income is already offered in subsequent assessment year, the same income cannot be added in a earlier year, because that will be double taxation. Double taxation is not allowed in the income tax law. So let me say assessing officer still wish to add in a first assessment year, then he need to pass the order by saying that in a subsequent assessment year, this income shall be reduced. But no one do so. And because of this reason, the addition made by AO is deleted in the appellate forum. Is that clear? So this is the second scenario. Now, I also will discuss some of the contention which you should not raise during the assessment proceedings, because let assessing officer make the mistake. And because of his mistake, we can take the advantage in the appellate forum. And because of that mistake of AO, addition is deleted not on logical basis, but on technical ground. I'll discuss later on, but moving to the topic. Now, different accounting methods are allowed that I'm discussing. 26 years EIS कैसे check कर सकते हैं? So now I think capital gain report is available. If you have some young chartered accountants are there, I'm just putting it on paper that whenever any shares or mutual fund units are sold, the respective broker or the mutual fund house provide you capital gain report. So lots of assessee would be there in as your client who are not maintaining the books of account. So for those clients, it will be extremely difficult to identify कि capital gain कितना हुआ है, because for calculating capital gain, let me remind you, the first in first FIFO method is applicable. So for example, I purchase the different shares at a different time and also sold the same shares at different time. Or let's take an example, I have purchased the mutual fund units at a different time and also sold the same units at different time. So the unit which is sold in this year will be corresponding units, उसका costing कैसे ढूंढेंगे? तो corresponding उसका purchase unit ढूंढना पड़ेगा. तो corresponding unit ढूंढने के लिए we need to apply FIFO method. जो पहले आया वो पहले गया, तो पहले बेच दिया, तो बाकी कौन सा बचा? So that is now sold. So identifying that is extremely difficult. So you need not to worry about it, because capital gain reports are available which take care of this FIFO method, and you can rely on that and can offer the capital gain accordingly. You need not to calculate the capital gain in detail. Am I clear? So, for example, after having the capital gain report from different broker or mutual transaction, you can verify कि AIS का transaction सही है या गलत है. Is that done? Just a minute. Again, I'm reminding, please put your query in the respective chat box, wherever you are participating from. Now, this is the thing. Now, another not topic related with the additions, but it could be a future litigation or future addition. Why I'm taking small topic? This is small topic. This one, last one on the slide. I'm just first of all taking the background. Under section 44AB, earlier 44AB audit was applicable up to, if a turnover is up to 40 lakh, then that limit is increased to 60 lakh. Then after that limit is increased to 1 crore, and then after 2 crore. Not effectively 2 crore. 44AB audit is applicable if your turnover is above 1 crore, but now that tax audit will not be applicable if your turnover is above 1 crore but below 10 crore, and your cash payment and cash receipt during the year is below 5% of total payment or total receipt. So for example, during the year, my total payment made by me is 100 rupees. Out of that, cash payment is less than 5 rupees. Answer is yes. Then tax audit is not applicable though my turnover is above 1 crore, but it should be below 10 crore. That is the amendment made by 44, amendment made in the 44AB. Now, there are different sections are available. Those sections names are given 194A, C, H, I, N, J. It is given over here. Now, this section, let's refer brief. Section 194A talks about the interest on security. Sorry, interest other than on security. C talks about contract payment. H, commission. I, rent payment. J is a professional or technical fee. All these sections earlier, if your client is an individual or HUF, then whether this section will be applicable to your individual or HUF client, answer will be no. If he is not required to get his books of account audited in a preceding assessment year under section 44AB. Now, what happens? 44AB limit itself is not certain because lots of complexities are added. So there will be few individual HUF whose turnover are 9 crore and still he is not required to get their accounts audited. So because of this reason, before 2 or 3 years back, they have made the amendment in these sections wherein they are saying that if your individual HUF client is having a business and turnover is more than 1 crore, he is covered in those sections. If he is having a profession and his turnover is more than 50 lakh, then he will be covered by 194 ACHINJ. So now what will be scenario? Your clients are there who are individual, whose business turnover, for example, is 1.5 crore. Now, if you refer 44AD, if a turnover is below 2 crore, you can declare the income at the rate of 6 or 8% of the turnover. So ideally, your individual client is not maintaining books of account. You are declaring income at the rate of 6 or 8%. Still, lots of people are not aware. Still, for those individuals who are not required to maintain the books of account, who are not required to get their accounts audited, are required to deduct TDS if payments are above the given limit in a respective section. Am I clear? So please be careful, note down this point, but let's refer one step ahead. Your client who are covered under section 194 ACHIJ has not deducted TDS and they are covered in 44AD. And at the time of scrutiny assessment, assessing officer raised this point. I am very much sure lots of assessing officer will not raise this point because it will be difficult to identify the applicability of TDS from the bank statement because books of accounts are not maintained. But still, take a scenario. Assessing officer knows this provision, identify expenditure, and he offer to disallow this expenditure of, for example, 50,000. So what recourse would be available? First of all, same. Again, I'm repeating section 201, subsection 1, and some proviso is available over there which say, for example, if I make the payment to, for example, Mr. Samirji, and on that TDS is not deducted, I am covered in 44AD. So I need to prove that Mr. Samir Chaudhary has taken that amount paid by me as an income, has filed the return, and on the return income, whatever tax is there, he has paid that, and for if on this expenditure TDS is required to be deducted? No, because that on that income, if now TDS I will deposit, that TDS has to be refunded by income tax department to Samir Chaudhary. That is a completely useless exercise. Because of that, I now need not to deduct TDS. Is that clear? If I need not to deduct TDS, then also disallowance is not required to be made under section 40A IA. Is that clear? Now, one more thing. If your assess is covered by 44 AD, have you referred section 44 AD? 44 AD start with the non-abstaining clause by saying without prejudice to what has been mentioned in section 28 to 43. Some sections is there. So whatever this section says will not be applicable. So as per my consideration, disallowance of the expenditure cannot be made because 44 AD section says so. Shall I refer the section? Just a minute, let me. Okay. So this is a section. I think you can see the page. The section starts with notwithstanding anything to the contrary contained in section 28 to 43C, meaning thereby section 40A IA will not have any application if assess is falling in 44 AD, meaning thereby expenditure cannot be disallowed. But this kind of clause is not available under section 201, which says that if you don't deduct the TDS, you are at default. So obviously, department can treat you in a default for non-deduction of TDS. So for that, you can obviously prove that other party has paid the tax on the income which is paid by us. Is that clear? Now, just a minute. So another point, that is the as of now the loss of problematic things which are happening is a adjustment under section 143(1)(a). Am I right? So for that part, I have taken a small one of the topic which kind of different contentions are there which you can raise. So let's take a first of all background of the matter. Section 143 subsection 1 clause number A talks about the different adjustment. So now whenever we are filing the income tax return, if there is an apparent adjustment which can be made as per this section, then they will issue the notice and will make the adjustment. Why I'm saying will make the adjustment, doesn't matter what reply we are filing, we have a standard reply that no reply is filed or your reply is not acceptable. That's why we have made the adjustment of so and so amount. So they will make the adjustment. Now, what could be the our reactions or response to this kind of addition made by having the adjustment? Okay, done. So first of all, at the time of the return file, you have filed the return. There is a notice under section 143(1)(a) which says that this adjustment is required. If you open the income tax portal, as of now, you can file your response only in a word format. So whatever you would like to mention, you can mention by writing some words. Can you file any evidence as an attachment? Answer is no. So first of all, write your reply. After that, if a still adjustment is made, there is no option available with the assessee but to file the appeal. Let me remind you that this adjustment under section 143(1), intimation issued under section 143(1) is the appealable order, and we can file the appeal to first appellate authority. And now appeal filing is also online, so one should file the appeal. First thing. Now, what could be different contention what we can raise? So for that, first of all, first thing, see, whenever if you refer this section 143, over there it is clearly mentioned that department will issue the notice, and in response to notice, he assessee need to file the reply and department has to consider the response filed by the assessee. So that right is given under this section. Now, whether that right is fully given, properly given to the assessee, answer is no. Why? Because we can file the reply only in word format. Can we file our reply along with the evidence? Answer is no. So whenever this reply is not given properly, then this is a completely violation of the natural justice. Am I clear? So this is the violation of the natural justice. Whenever there is a violation of the principle of the natural justice, based on this violation itself, lots of CIT appeal as well as tribunal and even High Court quash the order. So please follow this, raise this contention if you are filing appeal and handling the appellate matter. Second thing, what you can do, you can at the time of the assessment, you can also take the one of the help of this judgment of the Mumbai Tribunal. Now, what was happened in this Mumbai Tribunal? In this case, let me give the background of the first of all factual background of the case and the provision. Section 36(1), Section 36, subsection 1, clause number VA, 5A. Now, as per this, employee contribution, if I am the employer, I am deducting anything from the payment of the provident fund or a gratuity or a leave encashment, then that payment I need to pay to the respective authority within the time limit as given in the respective law. So for example, I am deducting the PF, so I need to deposit the PF by 28th of the next month. If I don't deposit the same, that expenditure is not allowable. I'm talking about the employee contribution. If it is the employer contribution, then that is governed by section 43B, which says to deposit that employer contribution before the filing of the income tax return, then that expenditure, that payment by employer should be allowed as deduction. But the similar provision is not there for employee contribution. So for that, we need to deposit before the respective time limit given the respective law, not an income tax law. So now that was the litigation part. So except the Gujarat, most of the tribunal and the High Court except the Gujarat High Court has held that the benefit which is mentioned in 43B should be given for employee contribution as well. And then after to overrule this judgment of the different High Court and the tribunal except the Gujarat High Court, the department, the revenue or finance ministry brought the amendment by saying that under section 36(1), 5A, disallowance will be made if the amount is deposited beyond the time limit given in the respective law, though it is deposited before the filing the return. Now, what is happening? Section was clear, but because of the judicial pronouncement, there is a addition could not be made because of this employee contribution late deposit. Now that amendment came from assessment year, that is a 21-22 or 2023. So for earlier assessment year, this amendment was not applicable. So the CPC Bengaluru for assessment year, for example, 18-19 has made the adjustment for this late deposit. Why? Because tax audit report has mentioned ये पैसा late deposit हुआ है, तो 36(1)(5) के हिसाब से वो disallow नहीं हो सकता. So CA has reported that, and based on that reporting of tax audit report, CPC Bengaluru has disallowed the amount under this section. While dealing with this case, the Honorable Tribunal Mumbai bench has held that first of all, whenever any reply, they have said whenever a reply is filed by assessee during the 143(1) process, wherein they issue the 143(1) notice, whatever reply assessee filed, they have a very standard reply, which is observed by Honorable Tribunal. That reply standard, they mention simple that you have not filed the reply or reply filed by you is not acceptable. Why it is not acceptable? They not mention that. Rather, their format is very much simple, and a format they don't even strike off the inapplicable part. So one reason because of which they said that CPC Bengaluru does not consider the reply of the assessee in a purposeful manner. Second thing, they've also mentioned that whenever law is clear, but different judicial pronouncements are available, which is not in consonance with the law. So there is a debatable issue it will become. So this issue becomes a debatable because contrary judgments are available. And whenever any contrary judgments are available, the matter will become the debatable, and because of that, debatable matter cannot be subject matter of adjustment under section 143(1)(a). So based on these two reasoning, primarily they have deleted the addition. I also would like to share that judgment on the screen. The judgment is available. The judgment name, the party name was the Kalpe Synthesis Private Limited. Issue is again that employee contribution was deposited late. I'd like to refer the relevant part only. Just a minute. So, just a minute. The things which I have mentioned is mentioned. Just these are the response filed by the CPC. CPC has given the response. CPC has used the standard reason to the effect that as there has been no response or the response given is not acceptable, the adjustment is mentioned below are being made to total income and has not even struck off the portion inapplicable. To put a question to ourselves, can such a casually assigned reason which are purely on a standard template can be said to be sufficient justification for a quasi-judicial decision that the disposal of the objection inherently is. So what tribunal is trying to say, this kind of reason which are in standard format cannot give a purposeful output. So whenever matter reach to tribunal, even tribunal don't know why the adjustment is made. If a tribunal knows why adjustment is made, then he can decide whether adjustment or reason is right or wrong. So his incapability of tribunal to decide the matter on merits. Why? Because a CPC Bangalore does not have give the reason properly. Because of this reason also that adjustment was deleted. This is a very good judgment, very recent judgment, and should be used by everyone. If anyone would like to note down the judgment citation is available over here. ITA number 1785, Mumbai Tribunal 2021. This can be downloaded from the ITAT site itself if you are not aware of this thing. Though this judgment is reported by lots of reporting journals. Should I go to next? Done. So I think I have just a 5 minutes so that I can take a question answer session. So before that, I would like to take some other points. Before I may jump onto this thing, I would like to mention very gently to all the participants over here that if you are not handling or if you are not doing a first appellate work, please start doing the first appellate work. It is not much difficult. But if you are a kind of participant or a professional who are already doing the first appeal, let me mention you that lots of technical grounds are available based on which addition can be deleted. How you would know that? By reading the different judgments. So lots of judgments are reported freely by lots of sites. If you refer that, you will get to know that lots of other benefits are available. I'm taking one point. For example, if you are aware, for penalty, earlier applicable section was a section 270(11)(c). Done. So penalty under this section can be levied for two reasons: furnishing of inaccurate particulars or concealment of the income. Now, earlier before 5 years, lots of assessing officers were there who are mentioning both the limb of this section, and they don't clarify for which limb they have levied the penalty. So then after High Court have said, if assessing officer has not clarified any of the limb, then penalty order itself is not clear, because assessing officer himself is not clear for which reason is levying the penalty. And based on this reason itself, the penalty order was quashed. If you doesn't know this judicial pronouncement, you should know, because there is no logic. It is only completely technical aspect because of which penalty was deleted. One step further, while issuing the penalty notice under section 270(11)(c), read with section 274. Normally, assessing officer has a standard format where it is mentioned that why penalty should not be levied under section 270(11)(c) for inaccurate particulars, furnishing inaccurate particulars, or for furnishing for concealment of the income. So they mention both the things. So now, in one of the judgment by the Karnataka High Court, I guess, Karnataka High Court has mentioned that assessing officer should mention that for which limb he is issuing the notice as well. If he has not strike off any of the limb properly, then penalty proceeding is quashed. Now, is there any logic? Answer is no, but technically you can win the case. Now, because of this reason, nowadays lots of tribunal are quashing the penalty order under section 270(11)(c) for this reason, that assessing officer has not strike off the respective limb for which penalty is issued. So you should know this thing. Now, this is something which is technical. Second thing, for example, if a addition is made for taking the unsecured loan, if you are not aware, if unsecured loan is repaid in a subsequent assessment year, then in that case, few judgments of tribunal and even high courts are available, which says if amount is already repaid in a subsequent assessment year, then though that amount is not explained properly, the year in which it is accepted, no addition should be made, because there is ideally no black money is created by having unsecured loan. But obviously some other evidence we need to prove. But this is the thing. For example, if a assessment year, for example, 18-19 is going on, in which my opening balance of unsecured loan is 2 crore, in this year I have not accepted a single loan. Can a based on the opening balance, assessing officer can make the addition this year? Answer is no, because section 68 clearly mentioned the 68 addition can be made for any entry found in the books of account in the respective previous year. Now there is no entry in this previous year. If assessing officer wants to make an addition for unsecured loan, he has to open that assessment year in which that unsecured loan is received. So meaning that by once one assessment year in which I receive the loan, in that assessment year no scrutiny assessment is there, for subsequent assessment year that amount cannot be subject matter of addition. N number of things are there. Taking another point, there is section 244A which talks about the interest on refund. So let's say I filed the appeal in first appeal, I won the case. Then after, now we have paid the 20% of the disputed demand. Now my client should receive the 20% back. Now department does not give us the refund for 2 years for whatever reason it may be. So section 244A says that interest is required to be paid, yes. But in that section, there is also another subsection which says if within 3 months from the end of the month in which appellate order is received by commissioner, and within that time period refund is not granted, then additional interest is available at the rate of 3%. How many people know that? If you know this provision, after 2 years, if you put a right claim, your assessee can get a huge amount as interest as well. 244A, this additional interest is not granted by any assessing officer if you don't ask for that. So lots of things are available which you should know about it. For example, let me say in case of Divyangsha, reassessment is started for the bogus accommodation entry. Now, when reassessment order is passed, in my hand, there is no bogus assessment entry was found. So no addition is made, but some other additions are made. For example, the income, some expenditures are disallowed. So lots of, though law does not clarify anything, but lots of tribunal judgments are mentioning that if a reassessment is started for one point for which no addition is made, then no other addition can be made. So these are the judgments are available which are purely technical and should be known so that we can handle the assessment proceedings well, and not only assessment proceeding but also appellate proceedings. So with this brief thing, now I think I should be open to take the queries of the participants. Would request to share the queries. I don't know how we will resolve that.
Yeah. So the first query is there. Elaborate current updates in AIS, if any.
Just a minute. Give me one more time.
Yeah.
Yes, can you repeat the query now, please?
Yes, sir. The query is elaborate current updates in AIS, if any.
Correct updates.
Yeah, current.
I didn't get it. Correct updates.
Current updates.
Acha, current updates are there.
Yeah.
Okay, current
AIS.
updates I need to mention all the participants. What are the current updates in the AIS? In the AIS, just a minute. I think I had a rule available. Well, show you the rule. It will be very much clear to everyone. Yes, I had that readily available. Great. I am sharing a particular rule. To the query is something like this. What are the current updates or changes are there for AIS? If you had this query, first of all, what are the reportable transaction in the AIS? For that, applicable rule is a 114E. You can download this rule from the income tax site as well. What are the reportable transactions are mentioned over here. Now, all the transactions which are years old are must be known to you. The only changes are made in the the changes are made over here. This is the rule number 5A is added. I hope that you are able to see the rule 5A, sorry, sub rule 5A. So if you had a capital gain on transfer of listed security or units of a mutual fund, that transaction shall be reported in a capital gain format. That is a new thing which is added. 93A is the point number of for rule number 5A, where it is added 93A. 93A is added by on 12th of March 2021. So before 1 year and 3 months. So this is the first thing. Second thing, dividend income will be reported by company and even interest income will be reported by company. So these are the new changes in AIS. All the other reportable transaction in the AIS are very much old, meaning thereby if your client sell the property or purchase the property, value of which is more than 30 lakh, it is a reportable. If your client deposit the cash which is more than 10 lakh in a saving account, it will be reported. If your client deposit the cash more than 50 lakh in a current account, it will be reported. If your client having made a fixed deposit more than 10 lakh, having the investment more than 10 lakh in the mutual fund, purchase debentures, bond or shares more than 10 lakh, those all transactions will be reported. Now, if you withdraw the cash more than 20 lakh and TDS is deducted, that is not reportable over here, but that will otherwise shown in the 26 years. So these are the transactions which will be reported. Hope that your query is answered. Done. Next query, please. Am I audible? Waiting for the next query.
The next query is, instead of claiming GST as ITC eligible credit, can the SEC claim the GST along with the concerned expenses in P&L?
Okay, so you wanted to claim the GST payment as expenditure. See, section 145 A or some sections is there, 145 or 145A. In that section, they have mentioned it clearly. Just a minute. For that, let's go by the section. It will help you to understand very meaningfully. Just a minute. Can I know how many queries are there? So I can take a
Sir, queries are many, but we make it take few of them because we have next session at 2:30. So
Okay,
till then, whatever we can cover.
So I'm jumping to the conclusion directly. First of all, the query, whoever the query has raised, refer the section 145A. Over there, they have mentioned the method of accounting in certain cases. So they have mentioned clearly, if you can follow two methods, inclusive method, wherein you can show the GST collection as a part of the income, and a GST payment as a part of the expenditure, that is purchase or expenditure. If you follow any method, your net profit will not change. Okay, so ideally anything you follow, your net profit should not be changed. If you follow the exclusive method, still net profit will be same. So I think whatever you do, the net profit will not change. Next query, please.
The next query is government contractors completion contract method only applicable.
Can you repeat the query again?
The next query is that government contractors completion contract method only applicable. Reference has not been given, so question is not very clear. We take the another one.
Please. Still, I would like to give you some answer. I think for the government contract only contract method or percentage of completion method will be applicable. That is not right. Huh? Next, please.
Next question is if the deductor paid the amount also intentionally.
If a deductor
paid the amount also intentionally.
Okay.
Again, it's a partial question. Another question is that how the processing of return by CPC can be rectified, as there is no such facility in the income tax portal for rectification of mistake, giving that there is an error taking income by CPC.
First of all, I think your query is something like this. If a CPC Bangalore process the return and issue the intimation under section 143(1), there is no option available as of now to file the rectification under section 154. Answer is yes, but because this new portal has came into picture, earlier rectification could have been filed. So wait, there will be a pop-up available wherein you can file the rectification against the intimation. But problem is there, if you file the rectification for the same thing for which they have made the adjustment, they are not going to accept your contention. And again, they will issue the same 154 by having the same adjustment. So that is not a good course of action. If you wanted to pursue that course, file the appeal against the 143(1) and you can file the rectification simultaneously. Next.
Next query is what is to be done if addition is made based on 26 QB, even though 26 QB is not correct in case of buyer as unexplained investment.
Okay, in case of buyer, if you are your client is a buyer or seller, whoever you are, if information given in 26 QB is not right, provide the sale agreement properly and mention that this amount mentioned 26 QB is not right. And whatever transactions are shown, that is a payment made by purchaser to seller, to provide the bank statement that more than this, whatever amount is mentioned in the sale deed, more than that amount I have not received. So whatever amount is mentioned 26 QB is not right, and that's why based on that addition should not be made. This whatever judgment I have shown you of Surat Tribunal will be applicable in this case as well. Okay, so you can take the help of that in the appeal. Go ahead. Next, please.
Next question is most of the AO not taken all the printout of our submission. What we can do?
See,
again, query is most of the AO not. Yeah.
Please read it again.
Yeah, most of the AO not taken all the printout of our submission. What can we do?
See, frankly speaking, if your assessing officer is not taking a printout of all submission, first of all, I don't know how you would know that he's taking a printout or not. But still, if he's not taking a printout in your submission, put a by default para that if you are not getting agreed with her submission, then whatever addition you wanted to make before that, kindly allow a opportunity of being heard. So video conference through वो opportunity लेंगे. उस time भी अगर आपको लग रहा है कि उसने प्रिंट आउट नहीं लिया है, then you can share your screen on the screen, and on the screen you can show कि देखिए ये यहाँ पर है. And because of that reason, an addition should not be made. So that could be another way of explaining him. You need to be slide techno savvy now. Next, please. And next one more thing. If your submission is not taken care at all, and draft assessment order and final assessment order is same without considering your submission, then you can file the writ in the High Court, and High Court has quashed the assessment order by asking to assessing officer to pass the order again.
Next query is, for the purpose of determination of deemed income under section 44 AD, turnover includes taxes collected separately. Kindly clarify.
No, taxes are not part of the turnover. If you refer the ICI guidance note, over there will be clarification. Though income tax is not clarified, but yes, tax cannot be part of the turnover for sure.
Now the last question. Can stay on recovery proceedings obtained without paying deposit on disputed liability?
Okay, so I'm assuming your demand is, for example, 10 lakh. You have filed the appeal to first appeal. If you have not filed the appeal, stay is not available. You need to pay the amount. So I'm assuming your appeal is filed in front of the CIT appeal and you don't want to pay at 20% also. In that case, yes, a full stay is allowable because for this circular is issued by CBDT that in a very deserving cases, assessing officer and then after CIT has a power to grant the full stay, but practically those people are not granting you full stay. But one thing is happening, whenever we file the stay application with the CIT, they don't dispose of the stay petition at all. They don't pass the stay order at all. So once stay application is pending and CIT has not passed any order, so in between the time, assessing officer cannot recover the tax. So whenever you are making a stay application to CIT, mark a copy to the AO as well by requesting कि जब तक हमारी stay petition pending है, don't recover the amount because that is what held by lots of high court as well. So this could be a good solution. Next.
Thank you.
I think done.
Yes, Divyang ji, there were still many questions, but now since the time is already 2:31 and
Yeah,
next faculty is there for that. Special thanks to Rajnikant ji to manage the session in very well mannered, sir. And since it is said कि जब विराट कोहली ना बैटिंग करना आता है तो उसमें अच्छे अच्छे के छक्के छूटते हैं. The same thing is about this Divyang. I know since a long period it is already decade between us, our friendship friend, and I have seen that now all the points you have clarified, and it is always seen that many times when faculty is speaking and during his lecture, he always keep one PPT. But now you are the one who have delivered from many other resources to deliver these lectures, and people have, I am sure that they have get a very great knowledge on this part. Thank you, Divyang. Thanks a lot for this session and interactive one, I would say. Thank you.
Thank you for the good words for me. It really matters a good motivation for always. Thank you. Thanks a lot.
Great, bye. Friends, since we have already covered about income tax, now it's time to talk to our next faculty, next eminent speaker of today, dear Anand Ji Banka. Friends, when I'm talking about him, Dr. Anand Banka is a fellow chartered accountant with PhD in finance, an author of 7 best-selling books, and a celebrated faculty of course on international financial reporting standard. And he started young and always had a zeal for giving back to society. So he has shared his knowledge across globe, I would say, which means India, USA, UAE, and various other countries, to spread knowledge about IFRS among professionals and CA. He also started writing books in lucid language. He has been one of the youngest special invitees on the accounting standard boards of the ICI, the premier accounting body of India. He has consulted the ICI for drafting the equivalent IFRS and educational materials around it. At a young age, he has been partner of a top CA firm, one of the youngest director of a global accounting firm, heading their Pune and Ahmedabad office for accounting advisory practice, and is now heading the technical accounting desk and reporting for Vedanta Group and many more. He has been presented Silver Shield by the ICI at International Awards 2021 and for his research paper in accounting category. He has also been awarded the Young Achiever Award 2020 by the prestigious Indian Achievers Forum. With all these special achievements, I hereby welcome Anand Ji to the platform where more than 2,500 participants are there to listen you, sir. Sir, now the floor is yours. Thank you.
Thank you so much, Samir ji, for your kind words. Am I audible?
Yes, sir. Completely.
Thank you. So thank you so much. I'll now share the presentation without much ado. Just let me share the presentation. Okay. So friends, today we are going to discuss the Schedule 3 revisions, which is applicable for financial year 22, March 22 financial statements. So if you have still not prepared the financial statements of March 22, this is one of the most critical change which has happened in the current year. This change, there is, significant changes which have happened in Schedule 3. I am sure we all are aware of the changes. The idea today is to discuss the nuances of these changes. What are the implementation challenges around these changes? So idea is to discuss how can you better implement these changes. Now, if you see, most of these changes are related to banks requirements like stock statements, like any delay in your capital work in progress, or debtors aging, creditors aging, whether you have registered any of the assets which you have given on, given to bank for obtaining loans, whether you have registered that with MCA. So most of these requirements you would find is, coming or originating from banking requirements. So when we discuss the presentation today, we should keep in mind, what would suffice those requirements of a bank, because that is the main objective, it seems, from all these revisions. Let's start with the first major revision which has happened, which is in capital work in progress. Now, you would have found in many companies the capital work in progress or CWIP number is pretty huge and is continuing since many years. I have seen people having CWIP since 7, 8, 10 years. They keep on capitalizing expenses which they don't want in their P&L. They keep on capitalizing interest cost. So a lot of things go and sit into CWIP. And because this is capital work in progress, it keeps on being in progress, never reaching kind of conclusion. So that is the main issue or crux of the issue that we are dealing with. And hence this disclosure was proposed or is implemented now. So for all the CWIP that you have, whether it is for property, plant and equipment, which is your fixed assets, or it is for intangible assets under development, you need to give two kind of disclosures. We have 2 slides, the first one and the second one. The first one basically talks about any amount that you have in CWIP or intangible assets under development. You need to give aging of that CWIP. When I say aging, it means the total balance that is there in your CWIP. Suppose the total balance is 100. Now of that 100, what did you incur in last 1 year? What did you incur in last 1 to 2 years? And how much did you incur more than 3 years? That breakup you need to give. So for any or every CWIP project that is there on your balance sheet, you need to go in depth into your accounting system and identify what expense was incurred in which year and give a aging of the CWIP balance which is there on your balance sheet. So if you see on the screen, right hand side, I have given a format. In the format, the rows are broken up into 2 parts: projects which are in progress, projects which are temporarily suspended. Now, what is temporarily suspended? There is no clear definition of what is temporarily suspended. But if you refer to IAS 23 or AS 16 on borrowing cost, Ind AS 23 or AS 16 on borrowing cost, you will find that it defines something which is temporarily suspended, because borrowing cost standard says that when do you not capitalize interest in the CWIP? Okay, so there it says if the project is temporarily suspended, you suspend capitalization of interest on that project. Okay, that is why it defines what is project temporarily suspended over there. It says that if something is because of natural things which are planned, for example, if you are constructing a road or a flyover, in rainy season, you may have to stop work when it is heavy rains. Or that is something planned, that is something known, and hence that is not called as temporarily suspended. If you stop the work during rainy season, it is not called as temporarily suspended. Okay. One more example that it gives is if there is admin planning, some work going on in office, may not be on ground, but you are doing some planning, admin, something you are doing on that project, then also it is not considered as temporarily suspended. You should consider it as continuing or in progress. So that is a rough idea which is given in Accounting Standard 16 or Ind AS 23 on project temporarily suspended. So for the CWIP balance that you have on your balance sheet, you will break the projects into two parts: projects in progress and projects temporarily suspended. And then you give aging of each of the projects that you have in these heads. Okay. So the head is project in progress. Then you write project A, project B, project C, project D. When I say A, B, C, D, you don't write project A, B, C, D. You write names of the project or the location or what kind of project it is. For example, if the project is regarding road construction in Maharashtra, then you will write road construction project in Maharashtra. If you are constructing your factory in, say, UP, so you will write project on setting up a new factory in UP. So that is examples of how you can name the projects. Okay. So likewise, you will write names of the project, and for each project, you will give aging of when the expense was incurred and the total of that project's CWIP balance. Okay. Similarly, for project temporarily suspended, you will write names of the project and you will write the amounts. If the amount is material, I would suggest that you also write reason as to why it is suspended. Sometimes there are logical reasons and shareholders appreciate, understand, bankers also appreciate, understand those reasons. So it is better to give reasons for such temporarily suspension of projects. Okay. It says that this total, which is the last column, this should tally with the CWIP balance in the balance sheet. That is true. It should tally with the CWIP balance in the balance sheet. Now there is one play here. The same guidance note, if you refer to a ICA on this topic, okay, the guidance note says that for standalone, you have to give complete information for all the projects and the total should tally. For consolidated financial statements, so if you have a subsidiary and you prepare consolidated financial statements, so for consol financial statements, you need to give only for those which are material. Now, what is materiality? It says materiality is something which is more than 10% of the respective balance sheet item. Now, this is pretty vague definition of materiality. My understanding or what I can decipher of this definition of materiality is that you need to check if a particular project, if the total CWIP balance in your consol balance sheet is say 100, okay, any project which has a balance of less than 10, that can be considered as immaterial. Okay. For immaterial projects, you need not give project wise aging. Okay. You can give others as a separate line item as others, and in others you can give aging so that the total is equal to the balance sheet amount. That is how you will read in harmonization of what guidance note gives relief and what is the requirement of schedule 3. Okay. So this is about this table or this requirement. Now, the practical issue around it, the main issue is this aging. And like I said, whatever accounting system you use, say suppose you are using Tally or SAP or any system that you are using, you need to go back to the start of the project. And for each project, for each of the years, how much expense have you incurred, that you need to note it down. And basis that working, you will need to classify every amount of that project into these aging buckets, which is less than 1 year, 1 to 2 years, 2 to 3 years, and more than 3 years. Okay. and this information will have to be audited, and hence it becomes critical that the numbers are correctly brought out from the systems. Okay, this is the most difficult part of this disclosure. Let's go to the second disclosure, okay, on CWIP itself. Now it says if any of the projects of CWIP or intangible assets under development, if completion is overdue. Now what do we understand by completion is overdue? Completion is overdue means that when the plan was prepared for such a project, you would have some date in mind, some end date when the project would end. Say if the plan was prepared in 2016 and the assumption was, or the plan was, that the project will get completed in 3 years time, so that means 2019 the project should have ended. We are now in 22, so that means the completion is overdue, beyond the due date. Okay, in that case you need to give this disclosure. I'll come to the disclosure. And the second requirement is, if the CWIP project balance has exceeded its cost compared to the original plan. Okay, so that means when you had prepared the original plan of the project, what was the total estimated cost of the project that you had considered? What is the actual cost already incurred? If the actual cost incurred has already exceeded the projected or the original planned cost, then you need to give this disclosure. Now sometimes a question arises that should I only compare actual cost? What if my original planned cost was 100? I have incurred 80, but I need to incur another 25. That means it will cross 100, it will become 105. Should I give this disclosure? Answer is no. This disclosure is only required if the actual cost has exceeded the original plan. Okay, so if you have not incurred more than 100 right now, this disclosure is not required. Okay, what is the disclosure now? Two things are required in this disclosure. Okay, one is project wise. Now here again I've called it as project 1, project 2, but in actual you need to give names of these projects. The examples that I gave, like setting up a factory in UP or construction of a road in Maharashtra, something like this. Okay, so for each of the project, you need to estimate what amount of time will be required to complete the project. Will it be completed in less than 1 year, 1 to 2 years, 2 to 3 years, or more than 3 years? What is the time requirement for completion of each of the projects? The second thing is, what is the amount that you will incur? So the requirement is not clear here whether you will reflect, because here you will have to fill the amount, right? For each of the cell, you will have to put some amount. Question is, what is the amount that you will put? Will you put the amount that you need to incur to complete the project, or will you put the carrying value of the CWIP here? Some companies have taken a call that they put carrying value of the CWIP here. So if my project 1 is going to get completed in the 2 to 3 year bucket, the carrying value of the project 1 will be put in this cell. Okay, and some companies have taken a call that they will give estimated cost to be incurred in each of these years. Now the problem is in estimated cost to be incurred is, how will someone audit it, or how will give someone an opinion on such cost? It becomes very difficult. So there, if the company decides to give future expected cost, then it would have been, someone the company would have appointed to compute such cost, or they would have presented to their board, they would have done something about it. Okay, then it is, you can rely on such papers to get yourself comfort on these amounts, or you can take the amounts from those papers. Otherwise it becomes very difficult. So one can give carrying values of the CWIP over here, because that is definitely auditable, that is there on your balance sheet. Largely these are the issues which you have already discussed, but I will just quickly cover. the first point I have covered is the 10% which I said in the first table, where the requirement is that if it is material, then in console financial statements, you need to give only the material items and not the immaterial ones. The materiality is defined as more than 10% of the respective balance sheet item. Okay. The question which I discussed was how will the total tally? So you can put others line item so that the total tallies. 10% materiality, how to apply? I gave you options. One of the options or one of the better options is if the project is material. So if the project has a carrying value more than 10% of the carrying value of total CWIP in the console financial. In standalone financial statements, there is no practical expedience. So one wonders whether, whether in standalone financial statements, you will give everything, even if it is not material. Will you give everything? So that question one wonders. So answer is not clear, but it seems that you will need to give everything, even if it is not material, because it says that the total has to tally with the balance sheet number. Okay. Suspended. I have discussed what suspended projects mean. It is as per AS 16 borrowing cost or Ind AS 23 borrowing cost. What is overdue? That also we discussed. Okay. Overdue means if actual timelines for completion of an asset or project have exceeded the estimated timelines as per the original project plan. So that we have discussed. And last one also we have discussed, that is in point B, wherein estimated timelines and amount to be given, how to audit this information. So I said that if it is auditable, you can give future information, futuristic. Otherwise, you can give carrying value also. Many companies have given carrying values over there. Okay, the next big disclosure is on trade receivables and trade payables. Now you can see on the right hand side the disclosure which is required now, a huge disclosure. We have a very small trade receivable note right now, but this note on the right side is huge. Now let me take you through each item on the right side. If you see in the rows, if you see 1 and if you see 2, okay, 1 is if any debts are due from directors or related parties effectively, then you need to cover in 1. If there are trade receivables from other than 1, then you need to present in part 2. Okay. Now part 1 has subparts and same subparts are there in part 2. So we will explain only once. Okay. So first is considered good and secured. So if you have trade receivables which you consider good, recoverable, and it is secured. Okay. Second subpart is it is considered good and recoverable, but it is unsecured. Third subpart is it is trade receivables which have significant increase in credit risk. Now this is something only applicable for companies following Indian accounting standards, Ind AS, not Indian GAAP. Ind AS, if someone is following, then they need to give this. Trade receivables which have significant increase in credit risk. Okay. Otherwise, for other companies which are following accounting standard, they need to give trade receivables considered doubtful, trade receivables considered bad. Okay. Instead of that, here it is trade receivables which have significant increase in credit risk and trade receivables which are credit impaired. Inside each of these subparts, there is further sub-classification, which is undisputed, disputed, and allowance for bad and doubtful debts or allowance for ECL. Now, firstly, what is undisputed and disputed? So it's a very, again, something which is debatable. What is disputed, what is not disputed? So the guidance note has given a definition of what is disputed. On the left-hand side, first para, if you read, it says, a dispute is a matter of facts and circumstances of the case. However, dispute means disagreement. Disagreement between two parties. And that disagreement is demonstrated by some evidence, some positive evidence. Positive here does not mean dispute is positive. Positive evidence means the evidence positively shows or reflects that there is a dispute or a disagreement between two parties. Okay. So that evidence will support or corroborate the fact that there is a disagreement between two parties. In practical life, what it means? There has to be some exchange of letters or exchange of emails, something there has to be exchange of, which shows that there is a disagreement between two parties for you to call it as disputed. If there is no such disagreement, then it will come as undisputed. So you have undisputed trade receivable, you have disputed trade receivables. Okay. And then you have allowance for bad and doubtful debts for companies following accounting standards, and for companies following Ind AS, you have allowance for expected credit loss. Expected credit loss is ECL as per Ind AS 109. So I will not get onto Ind AS 109 right now. But this is how you will have to give. Similarly, for each good also you'll have to give into 3 breakup, doubt credit risk increase also you'll have to give into 3 subparts, and credit impaired also. Exactly same cases part 2. Now if we get onto the columns, okay, the first column is something which is not billed, and hence it's called unbilled. So if you have provided goods or services to your customer, but you have not billed them yet, so it will come under the first column, which is unbilled. Okay. So you would have booked revenue, you would have booked trade receivables, but you would have not sent an invoice to the customer. So first column unbilled. You have sent the invoice, but you have given a credit period of 2 months. And the credit period is not over yet. It is still in the credit period. In that case, it will go into the second column, which is undue. Okay. Or not due. Sorry. Second column, not due. Then comes the third set of columns, which has some 4 or 5 columns within it. This is if it is due, then after due date, whether less than 6 months have elapsed, more than 6 months have elapsed, more than 1 year, more than 2 years, more than 3 years. So you will have to give aging of your trade receivables also into all these categories, and the last column is total. Now, what are the issues? Okay, general issues. The first major issue that we have found in companies is people don't do settlement. For example, if I raise an invoice on a customer and the customer pays me, my ERP, Tally, SAP, whatever tool I'm using, will be able to give me aging only if I tell the tool that this money is against this invoice. If I don't tell the tool that money has come against which invoice, the tool, what it will do is, it will show aging of everything as receivable, all the invoices that I have raised till date as receivable, and all the monies that I have received will come as advance received. So it will show on one end that I have amounts to be received, on one end it will show I have received advance. So that is how the tool will get confused unless we tell the tool that money is received against which invoice. So it is like garbage in, garbage out. So many companies do not, in a proper disciplined manner, do it in their SAP or Tally or whatever tool they're using. This cleanup of settlement of each invoice, whether the money received is against which invoice, they don't do this. In that case, the aging will be wrong. So they'll have to work very hard in getting this aging out. Okay. The second issue which companies face is due date. Many companies don't mention what is the due date on their invoice. It is the understanding that it is 1 month, 2 months. Then it will be difficult to justify any due date. In that case, when no due date is mentioned, the guidance note says that you should consider the invoice date as due date. Then everything will be overdue. So it should be clearly mentioned on the invoice or agreement, whatever you have with the customer, what is the due date. Okay. The third issue will be, if your aging is in, more than 1 year bucket, 1 to 2, 1 to 2, 2 to 3, and more than 3 years, in last 3 buckets, if there is money lying, and if you have not created allowance for doubtful debts or allowance for ECL, then there will be questions raised as to why you have not created ECL. If someone has not paid you more than 1 year, then how do you have confidence that they will pay you now unless it is secured? If it is secured, then fine. But if it is unsecured, then the questions will be raised by banks, by shareholders, by stakeholders. Everyone will raise questions on your recoverability of these amounts. So these disclosures on one end make things very transparent. On other end, it also creates issues with the bankers and creditors and shareholders and stakeholders. So this is on trade receivables. The next slide is on trade payables. So trade payables also, if you see similar information, unbilled, not due, then due for what period and total. And in those, if you see micro, small, medium, we call it MSME. Technically, the requirement is to only give for micro and small enterprises. It is not required to give such information on for medium enterprises, only micro and small. So MS, this M information is optional. You need not give. Okay. And every others will come in this others. Here also disputed, undisputed. The definition of disputed remains same here. Okay. Now, what are the issues in this table? Firstly, same issue. If in your ERP, you have not done settlement, then this information will be incorrect, will be very difficult to get this information from ERP or SAP, Tally, whatever you are using, will be very difficult to get this information out. So first is that is the major issue. The second issue is MSME Act, MSMED Act, we call it, Micro, Small, Medium Enterprise Development Act. Now there it says anything more than 45 days, if you have not paid to micro, small, medium enterprises, then there will be penal provisions. And MCA is closely following it. So there it will be issue. This will be transparently disclosed. So disclosures were anyways there earlier also for your standalone financial statements. But here the transparency level goes up. So you need to ensure that all the payments which are for MSME, you pay on time. Okay. Again, if the due date is not specified, then anything which is billed, whenever the billing happens, the due date is that date, unless due date specifically disclosed. Okay. If you have significant payments which you have not made, if there are significant payments lying in this table, then the next time a vendor enters into an agreement with you, the vendor will be smart enough to bargain accordingly, because in back of its mind, when he will read your financial statements, he will know that your payments are not on time, you may not pay your vendors. Such issues will prop up in its mind, and hence you need to be sure that this table is clean. Okay. Just 1 second, I'm sorry. The weather is not too favorable to me right now. Sorry. My voice is also become little sorry. So I was saying the vendors, when they enter into a contract with you, and when they see this table, and when they see that there are significant amounts lying in this table for more than 1 year, they will definitely be more, they'll not be so keen on it, getting into contracts with you. So you need to be sure that such payments happen on time. Okay. On the other hand, you can also get into your customers' financial statements and read this table and get more information about your customers. So that's also the benefit of transparency on the other hand. Okay. The last issue in this table is many companies or many professionals do not understand the difference between provision and liabilities. This table is only required for trade payables. This table is not required for provisions. Okay. So you need to understand the difference between a provision and trade payables. For provisions, this table is not required. Now, if someone asks what is the difference between provision and trade payable, provision is something where either the time of when this liability will occur or when this liability will be payable, or the amount of the liability. One of these two things is uncertain. That means you are not sure what will be the amount or when will you have to pay the amount as per legally, okay, as per the due date, not when you will pay the amount. That is in your hands. Okay. But when is the amount due? Either the when is amount due, that is not clear or uncertain, or the amount is uncertain. In such case, it will come under provisions. Otherwise, this will be part of trade payable. Okay. Let me get on to the next slide. Next is on borrowings. Now, there was a requirement in Caro since many years now, but Caro used to require only end use or utilization of term loans. So it required a certification from auditor of sorts in Caro whether the term loans have been used for the purpose for which it was obtained. Okay. Now, Schedule 3 is wider. Okay. In a sense, wider, in a sense, not so wide also. So I'll explain how. So Schedule 3 earlier required such kind of disclosure only for securities. Now, what is securities? Generally, it was considered that debentures and bonds are securities. Now it says any borrowings from bank and financial institutions. If you do any borrowings, then you need to give a statement as to the utilization of such borrowings is according to the sanction letter, or the purpose for which it was borrowed, it is used for the same purpose. Okay, that is the statement you need to make. Now, what is the difference between Caro and this statement? One, Caro is for term loans only, whereas this Schedule 3 requires it for securities and all borrowings from banks and financial institutions. Okay. Now, what is the other difference where Caro is wider? Caro does not say this term loan has to be from banks and financial institution only. So term loans means any term loan from anyone. That is covered in Caro. Whereas in Schedule 3, it has to be from banks and financial institutions only. So that is the difference. The next one is also, a new and pretty interesting requirement. It says that if you have received funds from a person and that funds have been directly or indirectly lent or invested in entities or persons which are identified by the ultimate beneficiary or ultimate owner, beneficial owner of your company. What do you mean by ultimate beneficial owner? So your company, above that holding company, above that holding company, above that the promoter, you will have to go up to the top, the ultimate beneficial owner of the shares. Who is that person? Okay. So if any investment or guarantee or security you have given, provided for the benefit of the ultimate beneficiary, ultimate beneficial owner. Okay. So then you need to give this disclosure. Now this is very, very wide in scope. That means for every loans that you have given, for every investment that you have made, for every guarantee that you have given, or any security that you have given, you need to go and check, or as an auditor or as a company, you need to be sure, because company is giving the statement and auditor is auditing it. You need to be sure that it is not directly, indirectly, it is done on behalf of or for the benefit of the ultimate beneficial owner of your company. So that means I invest in A, and my investment in A, because of my investment in A, the ultimate beneficial owner of my company is getting benefited. Then this disclosure gets triggered. Now, when do you need to disclose it? One, when you receive any money for making such investment. So in the year when you receive this money, that then you have to disclose. in the year in which you make investments, then also you need to disclose. So 2 times you need to disclose: year in which you receive money, year in which you make investment, give guarantee, give security, give loans. Okay. If both are in the same year, then you have to disclose only once. If both are in different years, then you have to disclose whenever the transaction happens. Okay. So this disclosure is also required at console level. In fact, all the disclosures that we discussed today are required at console level also. There is no exemption at console level. Only some places they give a benefit, like in CWIP we discussed that 10% materiality threshold. Similar 10% materiality threshold is there for this disclosure also. Okay. So here also it says, at console level, it is required only if it is more than 10% of the respective financial statement line item. Again, pretty vague, but I would say that if any such amounts are material amounts or more than 10% of the total loans which the company has given, in that case, you need to give such disclosures. Okay. 2 small changes which has occurred and which is very logical is, one is current maturities of long-term loan. Previously, it was sitting in OFL, other financial liabilities. Now it has been shifted to current borrowings. So now borrowing short-term, long-term, current, non-current, if you add, you will get total borrowings. Otherwise, previously there were 3 places you need to go: non-current, current, and other financial liabilities. Now only 2 places. The second change which they made was security deposits. Previously was under loans. Now this has been shifted to other financial assets. So these are 2 very logical changes which have been made. The last thing on this slide is you need to give disclosures if you or your companies are classified as your subsidiaries, because it is required at console level also. Any of the entities in the group is classified as willful defaulter. Now, who classifies willful defaulter? These are classified as per the definition of RBI, as per the banking norms. If you or any of your subsidiaries are classified as willful defaulter, you need to disclose it. So, a lot of such requirements are coming from banking requirements, like I said at the start. So these are coming from there only. Okay, next one, stock statements. This is also an interesting change which has happened, again as required by the bank. Now, firstly, if you know, many companies submit monthly stock statements, many companies submit quarterly. Okay, most of them would submit monthly. Now, this requirement is only at quarterly level, the requirement of Schedule 3, that at quarterly level, the auditor will check whether the books and stock statement tie. This requirement is not to be done at monthly level. Even though you may be submitting monthly stock statement to banks, the disclosure or audit of that is not required by Schedule 3. It may be required by banks, that is a separate issue. Schedule 3 does not require. Schedule 3 says that when you prepare your annual financial statements, the quarterly stock statements that you submit to bank, that will be checked against your quarterly books of accounts. Whether inventory as per books, whether receivables as per books, whether liabilities as per books tally with whatever you have submitted to the banks or not. If not, then a disclosure is required in your financial statements. Okay. Now, many a times it happens, many companies submit stock statement by 10th of the end of the month. So June quarter, companies would submit by say 10th of July. Okay. Or 20th of July. But the results are the quarterly results that go in for SEBI, for listed companies, that are audited later on. Okay, that are reviewed later on. The publishing time is 45 days. So many a times after 20 days, there are audit adjustments which happen. So it is better that companies refile revised stock statements with the bank. Otherwise, such disclosures will get triggered. Okay. Now, the guidance note also says that borrowings at any point during the year. This means even if there was borrowings in June quarter, but that borrowings has been fully repaid by end of year, still you need to give that disclosure for that borrowing. Then even if you have limits which you are unutilized, but the limits are live, you can utilize those limits. You have not utilized, that's a different issue. And you are submitting stock statements for that limits. Then also this disclosure is required. Okay. Again, for consol financial statements, that materiality of 10% will apply. How to apply that 10%? They have not stated, but I would assume that if the amounts are less than 10%, if say inventory amount is 100 and the difference is less than 10%, you can apply some kind of materiality there. This requirement is there in CARO also and Schedule 3 also. But there is two differences between what is required by CARO and what is required by Schedule 3. The requirement of CARO only gets triggered where working capital limits sanctioned are in excess of 5 crores. This 5 crore limit is not there in Schedule 3. So all borrowings from bank where you submit stock statement, whether it is 1 rupee, 1 crore rupee, 5 crore rupee, it is still required. The second difference is CARO only requires such disclosure in case of sanctioned working capital limits, whereas Schedule 3 says any loans or borrowings for banks or financial institutions, provided the security is based on current assets, which is inventory, receivables. So if the security is current asset, then you need to give this disclosure, irrespective of whether it is working capital or loans, term loans, or any such things. So Schedule 3, I would say, is wider than CARO. Next topic, loans and advances. Now here, a disclosure is required if you have given a loan which is repayable on demand. So many a times companies give loans without specifying the terms or period of repayment or on demand loans, so that these are not classified as overdue or default. To avoid such defaults or overdue status, they say it is on demand, or they don't specify the terms or period of repayment. To tackle that situation, this disclosure has come in that all such loans, you need to give disclosures. What disclosure will you give? Such loans, whether you have given to promoter, director, KMP, or other related parties. So repayable on demand, and then without specifying any terms or period of repayment. Then you need to give what is the outstanding amount and what is the percentage of total loans and loans which you have given, loans and advances on your balance sheet. What is the percentage of that? So that is what is required to be given. Now, what are the issues in this? Firstly, this is not carrying amount, so this will not tie up with your balance sheet. These are gross amounts, means before any provision or write-off or any such thing that you would have done, before any expected credit loss or provision, you need to give gross amounts here. The second thing is, as soon as you say it is on demand or terms not mentioned, someone can question whether these are at arm's length. Transfer pricing issues, such issues may arise. Okay. Other issues that may arise is, as per Ind AS, whether these are at fair value. If these are not at fair value, then adjustments may have to be done to these carrying values. Okay. And then expected credit loss is also something which will trigger, because these are on demand, and whether if these are not paid since long, whether the payment capabilities are there or not. So there are multiple issues which will come once you start collating such disclosures. Okay, next one. What are the other changes? There are few small other changes that are required to be given. Like title deeds of immovable property. Now, there is a disclosure required wherein the immovable properties whose title deeds are not held in the name of company. Now, these are related to the Benami properties, because here they are asking you whether the title deeds are in your name or not, and if not in your name, why it is not in your name, and in whose name it is. Such disclosures they are asking. These are to avoid any Benami properties or to transparently come out with Benami properties. In such disclosure, any TDRs that you have or plant and machinery which are embedded in land, these are not to be considered. Okay, but leasing should be considered. If you have leased an asset, that will be considered here title deeds of immovable property. Then this disclosure is not required in consolidated financial statements. But any which ways, Ind AS 16 has this disclosure anyways. So this disclosure, even if not required by Schedule 3, you will do in Ind AS. Only there in Ind AS, the formats are not there. So previously companies were doing it in textual format. Now in Schedule 3, there is kind of a tabular format. That's the only difference. Undisclosed income. So if there is any assessment which has happened, and in that assessment, okay, there is undisclosed income which has been surrendered or disclosed to the income tax officer. In that case, this disclosure gets triggered. So you need to disclose any undisclosed income that you have or that you have accepted or surrendered. That disclosure needs to come in this disclosure. Okay. You need to also state whether now in the current financial year you have correctly disclosed them or not. Okay. That also you need to disclose here. Okay. If you have immunity which you have obtained from income tax department from disclosing, then you are exempted. Okay. Otherwise you need to give this disclosure. Now the issues that arise because of this disclosure is prior period error. You need to assess whether these are prior period error or not. Most probably these will be prior period errors. So you need to go back and change in the financial year in which such errors happened. At least in Ind AS. In Indian GAAP, you will adjust in the current year, but in Ind AS, you will go back and adjust in the financial year in which it happened. This also triggers an issue in internal controls over financial reporting, ICFR. If you have not disclosed these things properly, or if you have accepted non-disclosure of income as in assessments, that is a ICFR issue. That means your company does not have enough controls to identify such errors, okay, and report properly. Other disclosures that are required is Benami properties. So if Benami properties, if you have, if there is any case which is settled, which you have, there is issue of Benami properties against you, your company, then you need to disclose that. CSR, corporate social responsibility. Now required under 3. Rinkesh bhai, hi. Rinkesh bhai.
Sorry.
So I was saying corporate social responsibility. Now you need to give disclosure at 3 different places. One is you need to give board report. Second, you need to give in CARO also. And third, now Schedule 3 also requires detailed disclosure of CSR. This disclosure is exempted from consolidated financial statements, only required in your standalone financial statements. Then Schedule 3 gives 11 financial ratios that you need to give. And if the financial ratio of current year and previous year, you need to calculate the variance, and if the variance is more than 25%, then you need to give reason for such variance. Now, one of the ratios which most companies I've seen have issue is return on investment ratio. Now, companies are confused whether I need to give return on investment by my shareholder in my company, or I need to give return on investment by me in my investments. So it is required from the asset side perspective. That means the company's investments which the company has made, what is the return that it is earning? So what companies can do is pick up your interest income, pick up your fair value changes, pick up your profit on sale of securities, such things you pick up, and then divide by your investments. Okay, that will give you return on investment. If you are trading in or investing in crypto, or virtual currencies. Okay. Virtual currencies is little wider than crypto. If you're trading or investing in such things, then you need to give disclosures. If you have transactions with struck off companies, now this is one thing where I don't know how companies are finding out whether they have transactions or not. Very, very difficult thing. What MCA has done is, now there is no consolidated report of all struck off companies at one place. Okay. All the ROCs, they upload their own list of struck off companies on their portal. So you need to go to each ROC and download that report of struck off companies. Now the issue there is, some of these reports are non-machine readable. That means you can't copy paste, you can't select. These are scanned in a manner that these are not machine readable. So it causes an issue that there is no one place where all struck off companies are listed or documented across India. All struck off companies, one place. The other issue is, the list that is uploaded on the ROC portals, it has PAN number and the company name. Sorry, it has SIN number and the company name. It does not have PAN number. It has SIN number and the company name. Now, without PAN number, so most of the companies in their vendor database, they capture PAN number, GST number. They don't capture SIN number. And this report has SIN number. So companies will have to add SIN number against their customer vendor names and then compare the two documents to identify whether they have any transactions with struck off companies or not. So multiple issues. This disclosure is very, very difficult to collate and disclose and be sure that you have done it with accuracy. Now, what are the transactions that is covered here? Transactions covered are, if you have done investment in securities of struck off companies, if you have receivables from struck off companies, if you have payables to struck off companies, and they talk about asset balance, not necessarily the transaction during the year. If you have shares held by struck off companies, your shares held by struck off companies, so you need to get SIN numbers of your shareholders also, or any other outstanding balances with struck off companies. So it covers the entire gamut, entire balance sheet in a sense. If you have any transaction with struck off companies, you need to disclose it. Then disclosure is required for shares held by promoter. Now, previously we used to disclose only those which are more than 5%. Shareholders holding more than 5% in my company. Now it says, for promoters, you need to disclose. If promoters are holding even one share, you need to disclose it. They are not covering promoter group here. Normally SEBI requires promoter and promoter group, but here they are covering only promoters. If you have done revaluation of your assets, and that revaluation is more than 10%, the change due to revaluation is more than 10% of your carrying value, then you need to disclose whether valuation is done by a registered valuer or not. This is a good disclosure to bring in, because then as a shareholder, as a banker, I can rely on that valuation. Okay. And this is exempted if you have done a fair valuation at the time of India's transition, then that fair valuation will not get captured here. You will be exempted from that disclosure. But in normal course, if you have done fair valuation and the difference or variance is more than 10% between the carrying value and the revalued number, then you need to give this disclosure. If when you take a loan against assets, you give assets and take loan, you need to register the charges with ROC. So whether you have done it on time or whether there is a delay. If there is a delay, what are the reasons? All this you need to disclose. Then there is a MCA thing on layers of companies that you can have. You cannot have more than 2 layers of companies. So if you have violated that section, that section of the law, then you need to disclose here. Last disclosure that I want to cover is if you have done any merger, amalgamation, any scheme of arrangement where you have deviated from the accounting standards. Okay, that disclosure also is required now. Previously, this disclosure was not required. For the first time, they are requiring such disclosure. If your scheme of arrangement is not as per the relevant accounting standard, then that disclosure is required. So that's it from my side. I will take up questions now.
Yes, sir. The first question is that bank disclosure is mandatory if no such transaction like aging format of debtors?
No, see, all these disclosures are mandatory in standalone also and in console also, except where I have specifically said that these are exempted or where materiality principles will apply. Other than that, everywhere standalone console, this is mandatory. The format, what is required is given in the schedule 3. Format can be this, format can be little different from what I have presented here. You can break into 2 tables, 5 tables. Format is flexible, but disclosure is mandatory. And when you say no such transaction, I am not sure, because all companies would have some data, right? Some data you will have, some receivable you will have. So, I believe this disclosure will be applicable to all companies. There might be some exceptions, some rare scenarios, but normally this will apply to all companies.
Next question is all the changes in SCH3 need to be put in subsequent quarters to after March 2022?
So all these disclosures are required in your annual financial statements, and also when you present your interim financial statement. So these are not required for your quarterly Regulation 33 SEBI disclosures. These are not as per Regulation 33. Regulation 33 will go as what is there. Okay. These disclosures will come in your annual financial statements, and for some reason, if you prepare interim financial statements, then in interim also, wherever there is material disclosures, because you may follow condensed financial statements format. So in condensed format, you only give material disclosures, you don't give all of them. So there is then a judgment call. If these are material disclosures, you will have to give in your interim financial statements also. So some of them will be applicable for interim, not all. For annual, everything will be applicable. Quarterly, Regulation 33, this is not applicable. Regulation 33 or Regulation 52, whatever is applicable to you, these formats are not applicable for that. Okay, we can go to the next question.
Yeah. Next question is any format of presentation of details about projects CWIP has been given in Schedule 3?
No, so Schedule 3 is more, of what disclosures are to be given and less about formats. So I would suggest that formats are flexible. You can choose your formats. I have given formats over here, which is, I've largely taken from the guidance note of ICAI. But these are, more of suggestive in nature. Till the point you are providing all disclosures required by Schedule 3, then you are compliant. Format is not that important or critical. Format is flexible. We can go to the next one.
Yeah, next question is, in case of project temporarily suspended, whether we should write note why projects temporarily suspended?
So not mandatory required. I said I would suggest it is better to write disclosure, give more information to your readers, but not mandatory. We can go to the next.
Yeah, next question is, start time of aging means material received, payment, purchase order, budgeted time, etc. Further, we project time is exceeding more than 1 year, then correct treatment.
So I assume your question is regarding CWIP. Okay, for CWIP, the start time of aging is from the date when you record expense in your accounting system. Normally, one records on receipt of material, or when the material is used in the asset in the project. It is not on the basis of payment. Okay, so whatever accounting standard you follow, and as per that accounting standard, you would be accounting for expenses. Basis that same accounting, you will prepare aging. So you just go back to the time when you first recorded any expense in the project CWIP in your financial systems, and follow that same dates. Don't rethink on what is the first date, because these are all many years old transactions. So don't get into that right now.
Now, next question is, in CWIP, suppose there are 1000 projects going on, whether all 1000 projects aging to be disclosed line wise in SFS from
The
one of the members.
requirement is that you need to disclose it. But if you have 1000 line items, then definitely it is not making sense to give in that manner. Maybe you can club some small projects into a bigger project, or maybe you can club some into as others line item, small ones, immaterial ones. But requirement is to disclose all, but you will have to take a judgment call here.
Next question is, if the receivables are LC back, whether same is considered as secured or not.
So see, generally guarantees are not considered as securities. Is not considered as secured. Okay, only if you have proper security with you, that is the time you can consider it as secured. Otherwise, it will be considered as unsecured. Okay, so anything which is guarantee in nature is not considered as secured. Now, if this is FD backed LC, okay, or the bank is giving that surety, it is like a bank guarantee. Okay, then like I was trying to say, that if it is purely a normal guarantee, it is not considered as secured. But if it is backed by a physical asset, if it is backed by FD, if it is backed by something, then only it is considered as secured. Otherwise, normal LC back will be considered as unsecured.
Next question is that the onus to prove MSME status is on auditee or vendor.
It is on the auditee. It is auditee's responsibility to get all details about its vendor. The responsibility is on the auditee. Now, if the vendor gives you a wrong representation, then it becomes debatable, because then you have done your best. But the first responsibility of primary is on you to go and check whether your vendor is MSME or not.
Now, how we should know whether vendors is registered under MSME or not?
You can ask the vendor. You can request the vendor to share the certificate, registration certificate as MSME. So you should do that. We ask for all the vendors at the time of vendor registration. We ask the details from the vendors. So that is how you would know.
Now, next question is, in case of MSME dues, where the PO is raised after 30 days, how should be the 45 days be calculated? Is it after 30 days as per PO?
So firstly, MSMED Act says that they will not go by any agreements that you have with MSME vendors. So your agreements, your POs, everything is not that critical. Whenever that MSME vendor raises an invoice, from that invoice date, you need to pay within 45 days. That is the requirement.
Next question is, a CWIP project which has original plan budget of 1000, when the actual cost incurred reached rupees 800, the company has taken approval of additional 200 at year, and actual cost incurred in the project was rupees 1100. Whether this project need to be disclosed as budget exceeded project?
See, very critical question, important question, and I had raised the same issue. What happens? Technology changes sometimes. Sometimes the cost overruns increases happens. Now, because of Corona, a lot of things changed because of which the project cost shot up. However, the requirement is from original plan, very clear. You can explain, first is this will come in overdue or cost exceeded the original plan. So that disclosure is required. You can give an explanation why it happened to explain to your readers. But it will trigger the disclosure because the guidance is you have to compare it with the original plan and not with amended plan.
Next question is, if loan liability is written back in books, what is the implication under the Income Tax Act? Is this taxable under Section 56 or Section 41?
So I am sorry, my friend, I am not an income tax expert. I am completely blank on this question. I can answer on accounting on Schedule C, but not on income tax. I'm sorry.
Right. Next question is, if loan or advance are transacted within group companies, how should it be treated in respect of disclosures as per Schedule 3 in audit report?
So loans or advance within group companies also you need to disclose. In console it will get eliminated, but in standalone you need to disclose whether it is on demand or whether it is without any defined terms for repayment or period of repayment, whether it is overdue. All these disclosures will be required as it is required for a third party. All disclosures will have to be given in standalone. In console it may get eliminated if it is in group company. So that's okay, but standalone it is required.
Right. Next question is, if the stock statement submitted to bank is valued at market value, should we need to get the cost value of stock submitted and compare the same with FS?
So see, generally what the standard says for FS is it has to be cost or NRV, whichever is lower. Now generally my understanding is we give carrying value to the banks. If you are giving market value to the banks, and if market value is lower than the carrying value, then you are in a issue. Then because it is NRV or cost, whichever is lower. Okay, but if market value is higher, then you need to compare carrying value. Now, if you're not giving carrying value and the banks don't ask for carrying value, then you cannot compare. Then you are saved. Okay, but if you give carrying value to the banks, it has to match with the books. So two conclusions to just summarize. One, if you're giving market value to the bank, market value cannot be lower than the cost, because otherwise it will trigger impairment issue for your inventory. Second conclusion is, if you're giving only market value to the bank and bank is not asking for carrying value, then you cannot compare the market value with carrying value. Then this disclosure will not be applicable.
Next question is, if any amount is given as loan by the holding company and then the subsidiary gives a part of this amount to another company, all these are group companies, how should this be verified and treated in disclosures?
See, how to verify is you need to, one, make inquiries with the management. Why have you given loan? What are the loan documents? What is your relation? You need to check the shareholding pattern of all such companies till the ultimate beneficiaries. So all the audit procedures you need to perform to get yourself satisfied. In addition, you can also take management representation, but management representation is only in addition. Okay, basic checks you need to do, like I said, get details of why loan was given, for what purpose, loan agreements you check shareholding patterns. So all those checks you need to perform.
Next question is, if any amount is given as loan by the holding company and then the subsidiary gives a part of the...
I think, sir, you're repeating the same question.
Sure, sorry. Next question is, for trade payable, receivable, CWIP, etc. disclosure tables, disclosure is for current year or for previous year also?
Both current year and previous year you need to give for 2 years, and you need to give standalone console. So that is the disclosure requirement.
Then how one can conclude that loans or investments have been made on behalf of ultimate beneficiary?
So you need to go through all the documents like board papers, management discussions, why the loan. So firstly, why did you receive money from whoever you received? Why did you give loans? So get into details, get into documents, make inquiries with the management. Like I said, get into shareholding patterns. So make all those disclosures or audit procedures, and that will give you your answer.
Next question is that will the income adjustment done on account of arm's length price, adjustment by transfer pricing auditor in the return of income fall under undisclosed income specified herein as warrant reporting? Also kindly confirm is the adjustment is a small amount which does not give rise to secondary adjustment of actual recovery from international group. Should this also be disclosed?
So one, it does not differentiate between the type of income, surrendered or disclosed. So all incomes, even if it is because of arm's length, this may or may not trigger an adjustment in books of accounts. Okay, but this will definitely need to be disclosed. Okay. On materiality, the materiality aspect in Schedule 3 has been only brought out in consolidated financial statements. In standalone financial statements, they have not brought out the concept of materiality. So, and in case of any law compliance issues, generally it is considered that everything is material. So I would say that this disclosure will be required for such issues.
Next question is that whether disclosure is required for the immovable properties held as a stock in trade if the
No.
title of such properties is not
No,
in the
no,
name
no.
of the company.
No. So if it is classified as inventory, stock in trade, then that disclosure is not triggered. It is only for the fixed assets or property, plant and equipment.
Right. If there are no transactions for a company like borrowings from banks and financial institutions, loans and advances to directors, etc., is it necessary to take the fact that there are no such transaction in the notes to the financial statements?
So this is tricky question. See, what some of the firms have done is they have given at the end other matters kind of paragraph, and there they have listed down that these Schedule 3 requirements are not applicable to the company because of there is no transaction. Some companies have made selective when it is not applicable, then they have gone through the paragraph technically and seen only at some places such negative confirmation is required, that there is no transaction, or a confirmation is required that there is no transactions. Otherwise, most of the places, even if you don't give a confirmation that there is no transaction, it is fine. So I would say there is mixed practice. Some firms require confirmations in all scenarios. Some firms require confirmation only in critical scenarios, critical cases. Okay, but that's a mixed practice. So you can take a call which ones to disclose, which ones not to disclose. I would suggest, generally I read it in this fashion, the Schedule 3, that if there is a transaction, but there is no non-compliance or no delay or no disclosure getting triggered, but transaction is there, then you give a positive confirmation that there was transaction, but there is no, for example, like loans, you have given loans, but all loans, none of the loans are on demand or without any period or term specified. If that's the scenario, then you give a confirmation that none of the loans fall into such categories. So if there is a transaction but disclosure is not triggered, then you give a positive confirmation. If there is no transaction at all, like cryptocurrency, I don't deal in cryptocurrency, then you can skip that disclosure altogether.
Next question is whether revaluation done in earlier year prior to financial year 2021-22 also need to be disclosed.
So see, all the disclosures are getting triggered for 2 years, current year and previous year. So in previous year, if you have done a revaluation which is changing the balance by more than 10%, and if it is not done by a registered valuer, then you need, so even if it is done by registered valuer, you need to disclose. So yes, previous year will be covered by disclosure.
Now the last question, do we have to disclose even though the relevant para is not applicable, like merger, etc.?
So like I said, if there is no transaction at all, that means you have not done any scheme of arrangement in last 2 years, then you can skip the para completely. If you have done the merger, if there is a scheme of arrangement which has happened, but you have not deviated from accounting standard, then you can give a positive confirmation that none of the scheme of arrangements was non-compliant with or deviated from accounting standard. So that is how I would suggest.
So we are through with all the questions what we have received.
Thank you. Institute of Chartered Accountants of India has various committees, and under which committee for members in practice held the seminar today. And I'm privileged, to give vote of thanks to the faculties, very close friend of mine, CA Anand Banga, who is, I consider, not as the faculty for the subject, but I can consider him as an authority for the subject, who gives in detail, whatever is required, detailed disclosure requirement. I have done few projects with him, and he's thorough guy, and it's privilege for the institute to consider him as assets for our institute. So on behalf of the institute and committee, we are thankful to you, sir, and please give us chance again and again whenever help is required from the committee and the institute to address to the gathering. So thanks a lot, sir, for your time and valuable inputs on the topic, which is a hot topic. I can consider a hot cake nowadays, and I think this is like you have taken the seminar I think 5th or 6th time on this topic. So you are dealing with I consider this as your courtesy, or I can say your investment for the fraternity at large, where you are dealing with the same seminar for the various forums by giving enlightening to the members on this topic. Thanks a lot, sir, and I thank Institute for giving me this opportunity. Thank you, sir.
Thank you, Rinkesh bhai. Thank you so much. It's always
Thank
a
you.
pleasure to be invited for such seminars, and
Thank
I'll
you.
be happy to always come for such whenever I am invited. Thank you so much. Thank you.
Thank you.
We thank all the members for joining this seminar, and the committee will take initiative further to conduct such more seminars for the benefit of members at large. Thank you, all of us. Thank you.
Thank you.